Start.
So, good evening, everyone. On behalf of Western India Regional Council, it's really a pleasure for me to welcome you all on this third day of series on GST. And I'm sure everybody will be very excited for today's session, because today we have with us very learning, very knowledgeable, very experienced faculties. One is Sunil Gabhawalla sir and another is SS Gupta sir. And maybe some more surprises can come in between also. So, and I'm sure with the knowledge they have, definitely, so Sunil sir is also going to talk about a lot of new opportunities in GST also. So I'm sure we all will be benefited from your session, sir. So first of all, thank you so much for accepting the invitation and joining us today. So before moving further, I would like to request to our chairman WRC, Arpit Kavra, sir, please, if you can address just for a few minutes or a few words.
Good evening, everyone, and welcome once again, our day 3 of this wonderful series. Sectoral series again, and I'm really happy with the feedback that we've received for this, and more importantly, let me tell all of you that Sunil sir again brings in a lot of value whenever he deliberates. So if people we are in the world of chat GPT now, so if you want an output, effective output, you frame a relevant question and ask it. So this applies to here in this also. And when we have people like Sunil sir and SS Gupta sir, I would be happy if all of you could interact in a very, very effective manner. Frame your questions, ask your questions as much as you can, so that we can have a very good interactive response. And that will be the best learning possible in this interactive mode. We all await your feedback, and really, I'm really thankful to Shweta madam. I think she's still out there doing a bank audit, but she still made herself available for this. So thank you, Shweta madam, immediate past secretary of WRC. Praveen and Pooja, thank you for being around. You've been doing a good job, and the entire coordinating space. And people who are here listening to me, and if you would like to be a coordinator at WRC, please watch out our My Role at WRC section in the e-newsletter. Please fill in those details, reach out to us. We'll be more than happy to have you on board with us as well. Thank you and welcome, Sunil sir. Really always a pleasure to hear you, sir.
Thank you.
Thank you, Chairman sir, for your kind words. So quickly move towards formal sessions, but before handing over officially to Sunil sir, I request our coordinator Praveen to please introduce him before the participant.
Good evening to everyone. There is no need introduction to Sunil sir, but still it's a formality. Sunil sir is a chartered accountant in practice with 3rd rank all India level. He is also a cost accountant, and he is doing his practice since sales tax law. Now he diversified in service tax law. His YouTube channel have more than 60,000 views. He is a pan-India community of indirect tax professional on the front of GST implementation. His firm has been ranked as one of the top 10 GST consultants for the year 2018 and 19. He is a NICE accredited trainer and regularly conduct training session for department officer. Now over to you, Sunil sir.
Thank you, Praveen. It's always a pleasure to be speaking at the WRC with our vibrant chairman and the coordinators here. And it's a very interesting series which has been planned, wherein we are looking at each specific sector and looking at the issues around that sector. And this really shows that GST has reached its 2nd orbit of growth. The first orbit was when we used to take up topics and debate on the topics. Firstly, start with a basic informative series. Thereafter, we went into the analytical issues and challenges in the implementation. And now I think is the right time to really go into deep diving of specific industries, specific sectors. And as we that famous saying from Asian Paints says, har diwal ka eka kuch kehti hai. So same way, each industry will have its own nuances. And that's where I think this 5-day series, wherein in each of the days, we have 2 specific sectors. I think it's really the need of the hour. And I think that's what even the participants are looking forward to. The topic which has been given to me is relating to real estate. And real estate is one topic wherein I can keep on speaking for hours and hours. And I'm sure at the end of that entire talk, you might leave the forum being more confused than what you were. But having said that, yes, real estate is one of the prime aspects of any individual's journey. And we always say roti, kapda, makan. These are the three bare necessities of life. And that's where makan comes in as one of the most important facets of the entire journey of an individual. What we are going to talk about today are some critical issues which are plaguing this real estate sector. And without much ado, we straight away go into the various stakeholders which are involved in a real estate sector. We are all aware that traditionally you have a landowner, because ultimately any construction would happen on a land. Most of the times he may construct himself, but today with the prohibitive finance involved and the marketing and the other requirements, there is always a developer involved, and we'll talk about in detail the development agreements and the role of the development agreements. So there's someone who's a developer who typically would not own the land in most of the situations. He would take some development rights in a land and would develop and market that property to end buyers. The end consumer who's going to buy a property and stay in his dream home. Most of the times the developer would appoint an outside contractor to really do the basic activities of labor and construction. And of course, when there's a lot of money involved, government can't be left far behind. Today, in fact, whenever you talk to any real estate client, you'll realize that government is an equally, if not bigger, stakeholders in the entire process of the real estate journey. Be it the development premiums which they charge, the TDRs and the FSIs which they levy, and the various taxes which are being levied by them. Necessarily, a huge chunk of the collections from the real estate sector also goes to the government. And therefore, I would believe that government also is an important stakeholder. What we'll try to do is, in the next 1.5 hours which we have, we'll go through each of these relationships between these stakeholders and try to understand the key challenges or the issues in each of those relationships. And let's start with the first and the basic relationship, the relationship between a developer and a buyer. And that we all know is a relationship wherein a developer advertises a property registered under RERA and says that, look, I am going to construct this building. There will be X number of flats or units in that, and I am ready to sell you that. You keep on giving me stage payments. I enter into an agreement for sale with you, and I commit that I'll give you a delivery of a ready-made flat, maybe 2 years or 3 years down the line on a particular date. And I think the key issue here is what are the GST implications of sale of units to such prospective buyers, where people would invest in the project and expect a delivery at a future point of time. Of course, as far as indirect taxes is concerned, this area has been a perpetual work in progress. Right from 2004-5, when the entry under the service tax law was introduced for commercial construction and construction of residential complexes, there has been a controversy on this front. While the trade and industry understood this entry to cover only contractors, the department went overboard to say that even the builders step into the shoes of the contractors and would be liable for service tax under this entry. In fact, there was an explanation which was introduced to this entry. Thereafter, in 2006, there was an amendment in the VAT law also. And parallelly, all these things were keeping on happening. There are lots of judicial pronouncements at an appropriate forum. We can go into too much of detail of that. But right now, we don't want to go into that. Let's straight away jump to 2017. And in 2017, when GST was introduced, 2 or 3 things are important. The definition of service is meant to say that it is anything other than goods. And therefore, service is very widely defined. Also, Schedule 2, there's an entry 5, which talks about inclusion of construction of a residential complex or any part thereof intended for sale prior to receipt of completion certificate. And very loosely, it's a very long sentence. But throughout the presentation today, we will use this acronym, sale of under construction units. And what basically Schedule 2 tries to say is that the sale of under construction units will be classified mere as a service. And as we know, Schedule 2 is a classification schedule, identifying certain activities and classifying them either as supply of goods or supply of services. Now, when 2017, Schedule 2 was incorporated and the definition of supply or the scope of supply was given under Section 7, at that point of time, it apparently appeared that Schedule 2 was a deeming fiction. However, in 2018, we are all aware there was a retrospective amendment in the GST law, whereby Schedule 2 is made only a subject matter of classification. Meaning, we are now told from 1st July 17 onwards, of course, that if a transaction constitutes a supply of goods or services, then to classify it either as goods or services, we will have to go to Schedule 2, and Schedule 2 is therefore only a classification parameter. And this again will be important when we look at some of the observations as regards some of the decisions in the next couple of slides. While all of this was happening, of course, at the time of 2017, when GST law was introduced, we were told that there will be unfettered input tax credit, and therefore real estate builders and developers were expected to pay a higher rate of tax and were given an input tax credit. Lots of challenges around that. Based on the industry representations, there is a new scheme of taxation for builders and developers introduced from 1st of April 2019. And we are aware that as far as residential units is concerned, for projects starting after 2019, there is a 5% concessional tax rate, the so-called concessional tax rate, without any eligibility for input tax credit. And in fact, that's where you'll see that right from 2004 to 2019 and even today, there has not been a phase of 5 years where there has been a stability in the law. Always there has been changes. In fact, even in GST, which is itself a recent law, we always, whenever a real estate issue comes up, the first question which is being asked is it pre-2019 or post-2019? Because the laws are diametrically opposite. And of course, for the earlier period, in some of the cases, we say that the law really is deficient in terms of clarity. And therefore, there will be some interpretations which could be possible prior to that date. Post-2019, also, the clarity is brought in through notifications, and we will go into the legal challenges of those notifications as well. But I think the point which we are trying to make here is, when we are looking at builders, developers, we are going to talk about pre-2019 and post-2019. Let's look quickly at the legislative entries. We said service defined very widely. Schedule 2, talking about construction of a complex intended for sale. So both those things are important. There has to be an activity of construction of a building or a complex, which is a unit we slowly talk about. And that has to be intended for sale, except a carve out where everything is received after the issuance of a completion certificate. In that case, no GST will be applicable. Now, as we said, this is Schedule 2, which now is relegated as a classification schedule. We also have Schedule 3, Entry 5, which says a sale of a land or a sale of a building is neither a supply of goods nor a supply of services, therefore not liable for GST. Now, of course, sale of building, there is a caveat to it. We are told subject to Clause B of Para 5, which we just read a minute ago. So essentially, a very simplistic way to read this is to say that if a builder or a developer sells a unit after the receipt of completion certificate, it falls under Schedule 3, Entry 5, no GST is payable. But if he does the sale prior to this date, necessarily Schedule 2, Entry 5B is triggered. And then one would like to go into the notifications and look at the rates and the conditions in that regard. That would be a very simplistic and a default way of looking at things. But at a forum like this, it's important to really question whether that's the right way to look at it. We've talked about a few things up to now. Now we'll talk about a couple of decisions. And I think the entire genesis of this situation comes from a decision of the Supreme Court in Larsen and Toubro, which was originally K. Raja decision of the Karnataka High Court, went to the Supreme Court. The larger bench of the Supreme Court essentially said that if a builder or a developer enters into an agreement for sale and transfers an undivided interest of land and thereafter also does construction, to the extent that he continues the construction after the agreement for sale, he steps into the shoes of a contractor and therefore is liable to pay VAT. We are all aware of this deliberated decision. But one paragraph of that decision is very important, which I would like the participants to read, which is the second bullet point. It may, however, be clarified that the activity of construction undertaken by the developer would be a works contract only from the stage the developer enters into a contract with the flat purchaser. The value addition made to the goods transferred after the agreement is entered into with the flat purchaser can only be made chargeable to tax by the state government. Now, if we look at the second bullet point, we would find that the Supreme Court tries to classify the transaction as a works contract, therefore leviable to VAT and so-called service tax, only from the point when an agreement is entered into. Now, as you are aware, whenever a developer goes ahead with the construction of a project, with the development of a project, he would lay out the plans, he would start the construction, and many a times that construction is done in abstract. And of course, as and when people will come, they will keep on buying units. Now, if there are 20 units in the project, a few units will be bought, a few will not be bought. But the construction will keep on happening parallelly. Therefore, if there is someone who enters into an agreement for sale after, let's say, 80-90% completion of work, if we read this Supreme Court decision, what it says is that the component of service, the component of works contract starts only after the agreement for sale. So to the extent of the construction activity of 70-80% which was done, as per the Supreme Court decision, that activity was done by the developer for himself, because at that point of time, there was no buyer in the entire process at all. Now, this is what the Supreme Court brought about. Now, in that background, we go to the explanation to the service tax levy, which was challenged by the MCHI in the Bombay High Court. And the Bombay High Court turned down that challenge on the basis of a circular. And on that circular, and this precise point was raised, and on the basis of the circular, the Bombay High Court tries to bring about and defend the levy on the entire value. Again, the observation of the Bombay High Court is very important. What it says is, the legislative intent underlying the explanation, we are aware that through an explanation, a deeming fiction was sought to be created, was to bring about a parity in tax treatment by stipulating that unless the entire consideration is paid by the prospective buyer after completion, the activity of construction would be deemed to be a taxable service provided by the builder to the prospective buyer. The word deemed is very important. And the next sentence is also equally important. The scope of the existing service was consequently sought to be expanded. So essentially, the Bombay High Court was colored by the fact that there is a deeming fiction created under the service tax law. Without really going into whether the deeming fiction is correct or not, the MCA, the Bombay High Court goes and says that yes, if there is a deeming fiction, we would be fine to impose a service tax on that because of that deeming fiction. Now comes GST, wherein the words have been pari-materia picked up from the service tax regime, the explanation which is now becoming somewhat similar wordings have been there in the schedule to para 5b, which we just talked about. Now, of course, as we said, a conservative view would be to say that post-completion certificate, no tax, sale of under construction units are liable for GST. But as I said, we need to think through about this facet. If you really look at it, there is a possible legal view to say that sale of under construction units are not liable for GST. And to say that, one will have to really go back to the structure of Section 7 of the GST Act. Now, if you look at Section 7, subsection 1, because 1A, because that's the only section which is relevant for this discussion, it says all forms of supply of goods or services or both are liable. Now, it also we need to bear in mind that per se, an immovable property is neither goods nor services. And there's a long discussion around whether service can be so wide to cover anything other than goods, when contextual interpretation may be required. And if one takes that contextual interpretation, one will say that in general, when a builder enters into an agreement for sale, while there is a commitment to construct to some extent, there is primarily a delivery of a completed flat. If the occupation certificate or the completion certificate is not received, the possession cannot be given, and then there is no value available to the buyer. And the whole purpose of a buyer booking a particular unit is to get a delivery of a completed structure. And therefore, one may say that this phrase, all forms of supply of goods or services, by itself cannot include sale of under construction units. One will talk about Schedule 2, but then because of Section 7(1)(a), which is retrospectively inserted, Schedule 2 is merely a classification and it's written in section 7(1)(a) itself. And that section 7(1)(a) or schedule 2 will apply only in case a transaction is a supply. If we are saying 7(1) itself does not apply, then you don't need to go to 7(1)(a). And further, just because there is a schedule 3 saying that sale of building is excluded, that by itself cannot presume an existence of a supply. We cannot reverse read an exemption or an exclusion to presume a taxability. And that's where I think a possible view would be to say, though litigative, there's a possible view to say that sale of under construction units are really not liable for GST. There's one more way to look at it. We talked about the Supreme Court decision of Larsen and Toubro, wherein admittedly it has been said that to the extent that construction is carried out prior to the agreement for sale, the construction is carried out for oneself. And therefore, that value cannot become a subject matter of a works contract or a service, or therefore a subject matter of GST. Now, if we look at the entire scheme of the GST law, there is no carve-out provided for construction already completed before a transaction of sale. And therefore, the valuation mechanism would fail. And we are aware of the Supreme Court decision of B.C. Srinivasa Shetty and Gangaram decision. All of them very clearly bring out that if there is no clear valuation mechanism or a calculation mechanism, then the levy itself fails. And I think that is also one argument which can be taken up. The Gujarat High Court in Munjal Manishbhai Bhatt's case actually went ahead, and there are detailed observations on this aspect. And perhaps if someone is stuck, one may try to look at this type of an argument to canvass that perhaps the levy itself is not free from doubt. Of course, this is something which is a contrarian view, and one may like to take it depending on the facts of each case. A general default answer, as we are all aware, would be to say that, look, nowadays there is a service which is very widely defined, and Schedule 2 specifically talks about including the concept of sale of under construction units into the concept of service, and therefore you will end up paying a GST. If you decide so conservatively that you would like to pay the GST, end of the day, it's an indirect tax to be collected and paid. We are aware of this notification, and we are right now plotting the post-2019 notification, where different types of tax rates have been given. We are all aware of these tax rates and different entries: affordable housing at 1%, other residential apartments at 5%. Even if there is a commercial apartment in an RREP, that also will be 5%. Of course, there is a tolerance limit of 15%. So an RREP, real estate, residential real estate project, is defined to be an real estate project where the commercial area is less than 15%. So if your commercial area is less than 15%, even the commercial apartment of that RREP would be 5% tax. Affordable residential apartments in a non-RREP will again be 1%. Other residential apartments in a non-RREP will be 5%. And all of these will come with an important caveat that no input tax credit is available. In fact, the only place where input tax credit is available is for commercial apartments in a non-RREP, and that comes with a higher tax rate of 12%. I'm not talking about ongoing projects where you have exercised an option to continue with the old regime. If that be the case, then you will get 8% with ITC for affordable housing projects which are ongoing. And if it is a residential housing project which is ongoing, then you will take 12% with input tax credit. Now, couple of things which we need to bear in mind is, if you are going in that ongoing project entries, entry 3(1) IE or entry 3 IF2, in both those cases, you will have to exercise an option. And there was a timeline of the 1 month when the new scheme of taxation was introduced. And within that month, you had to submit in writing to the department that I want to continue with the old scheme. Only if you have exercised that option, you can go with the 8% with ITC or 12% with ITC. Otherwise, only for commercial apartments in non-RREP, you have a 12% with ITC. In all other cases, input tax credit is totally debarred. Of course, as information we are aware that affordable has been defined based on the carpet area and the value. And we are also told that the tax has to be paid from cash only. Even if you have old accumulated input tax credit, you cannot claim that. You cannot use that for paying the taxes for the future transactions. There's also this notification, which we broadly say 80-20 scheme, which requires you to procure at least 80% of your goods or services from registered dealers. If there's a shortfall of procurement, then you are required to pay reverse charge mechanism, tax on reverse charge mechanism on that deficit. And you have to maintain project-wise, financial year-wise records, and all those things are there, procedural parts. We may not go into too many details over here. But this broadly summarizes the tax rates applicable for a transaction between a developer and a prospective buyer. Now, for that transaction, we go into some ancillary issues other than the tax rate. And I think one important issue which keeps on plaguing this sector is the time of supply. And again, a first blush answer to consider the time of supply is to say that when a builder enters into an agreement with a buyer, that agreement is to provide a construction service, and that agreement would typically last for a period of more than 3 months, and therefore would qualify as a continuous supply of service under section 31(5)(c). If one says that yes, it satisfies the test of being a continuous supply of service, we are aware that at the achievement of each milestone, there is a deemed completion of the service. And then the time of supply is told to be the completion of each milestone or receipt of advance, whichever is earlier. Now, this becomes very important in case of an ongoing project or even a new project, wherein a developer, the moment a milestone is achieved, as we know in the agreement for sale, there will be a slab-wise payment that on completion of the second slab, this much percentage will be due. Fourth slab, this much percentage will be due, like that. There will be a table or a payment schedule in the agreement for sale. Now, if we interpret the transaction to be a continuous supply of service, the moment that event is happening, let's say the architect certifies that the second slab is completed, which means one payment milestone is achieved. In that case, irrespective of whether you receive the money from the buyer or not, you would be expected to raise a demand note on that day and pay the GST on that day, because the liability gets triggered due to the concept of deemed completion. Another view, which is succinctly accepted by one of the recent clarifications, which we will be talking about, is to say that essentially the entire transaction is not really a continuous supply of service. My service is really a grant of a possession of an immobile property with a title. It's only because of a deeming fiction that it becomes taxable. But my day-to-day act of constructing some part of a transaction or is a performance, that by itself does not mean that the buyer is getting that service. If one interprets the transaction to be essentially in the nature of a grant of possession of an immobile property, one would say that the service really happens one time and not continuous, and that is at the time of possession. And then the transaction really does not become a continuous supply, but a normal supply of a service on the date of the possession. Make no mistake, in the interim, you might be keeping on receiving monies, and if you receive money, we have a law which clearly says that advances are liable for tax at the time of receipt. Either receipt or completion, whichever is earlier, is the general principle of time of supply. And therefore, you keep on paying taxes as and when you keep on receiving advances. And whatever is the shortfall of the tax, that tax will be paid at the time of possession, because completion happens only at that point of time, and there is no deemed completion at each milestone. Now, this view, of course, to some extent has been supported by a recent clarification. This may be slightly litigative, but it is very convenient because it addresses many of the challenges which a builder will face, especially in the case of a cancellation or a situation where there are some adjustments in the interim period. So this is one aspect which one needs to bear in mind. And that takes me to the impact of cancellations. Now, if the builder or the developer has taken a position that this is a continuous supply of service, necessarily he would have issued an invoice at the time of demand, raising the demand, and he would have paid the GST at that point of time. Now, many a times, because of various reasons, there will be a cancellation. Now, there are different ways in which cancellation will happen. And we will right now talk about a very simplistic case wherein a person books a flat and he surrenders the flat back to the builder himself by way of a cancellation. Now, in those cases, the situation which comes is at the time of receipt of advances and the different invoices for the demand notes which have been raised, you had as the bidder, you had paid the taxes. Whether you can issue a GST credit note, I would believe yes, we can issue the GST credit note because section 34 talks about deficiency in service or reduction in taxable value. I would believe that both these concepts are wide enough to cover the situation of a cancellation of a contract, and therefore a GST credit note can be issued within the timelines. We are aware of those timelines. If an invoice is issued in a particular year, then by the November of the next year, the credit note has to be reflected in the returns. So that if the timelines are met, then you can do a self-adjustment against other tax liabilities. And if those timelines are not met, you may not be able to issue a self-adjustment GST credit note, but you can file a refund claim. Either a builder can file a refund claim or the buyer can file a refund claim. Circular 188 definitely talks about this aspect. And this is where the earlier slide where we talked about interpreting the transaction not as a continuous supply of service, but a one-time supply of service becomes important. Because if you are going to treat it as a one-time supply of service, every money which was received prior to the completion certificate would be disclosed as advances. Of course, tax would be paid as and when the monies are received, but would be disclosed as advances in the GSTR1. And we are aware that for adjustment of advances, there is no timeline required, or there's no under the law or under the GSTR1 form also. And therefore, it would be little bit convenient for the developer to really handle this timeline related challenge in that manner. So this is one facet which one needs to bear in mind. But when we talk about cancellation, we also need to understand that there are multiple facets to this. While a cancellation might appear simplistic, that a buyer would have paid 1 crore rupees and is getting back 1 crore rupees. Practical scenarios, there would be price differences. The project might have reached a particular stage, and therefore there might be 2 or 3 different ways in which this cancellation can happen. And I think 2 ways is, one would be a scenario where the first buyer would cancel the allotment with the builder, and the builder will enter into a fresh allotment with the second buyer. Now, of course, for the cancellation of allotment to the first buyer, the suo motu adjustment which we discussed earlier will apply. There could be 2 different situations in this case. If the price has reduced, many a times the developer will charge a cancellation charge. And for this cancellation charge, Circular 178 tries to say that the cancellation charge would be given the same treatment like the underlying service and liable for GST at the rates which are provided for the underlying service. The said circular also says that if the payment is for breach of contract, then it is not a supply and therefore not liable. So if there is a cancellation charge levied by a developer to buyer one will really have to go down to the essence of the transaction and see whether the cancellation charge was a facilitation supply incorporated in the original agreement for sale. If so, then the 5% without ITC which was paid gets adjusted. There's no question of getting any refund of that amount. But if the original agreement for sale is silent on this facet, and if one is able to attribute the cancellation to some breach of contract by a buyer. For example, buyer one was expecting a home loan, but he does not get a home loan, and his financial condition is not there to commit or meet the obligations which are being cast by the payment schedule. In that case, one can say that the cancellation is initiated by buyer one. It is because of a breach of contract by buyer one, and therefore the cancellation charges are more in the nature of penalties or damages in the nature of liquidated damages, and therefore they are not a supply and therefore not liable. So depending on the fact situation and the documentation, we can have multiple answers as far as the cancellation charges levied by the developer is concerned. Now, there could be another scenario that the person had invested 1 crore, but the property has developed and there has been an appreciation in the value. Therefore, the developer gives certain type of a compensation to buyer one for a price difference. And then the question which comes is whether the price difference received by buyer one is liable for GST. And to address that question, one will have to examine whether there is any element of service rendered by buyer one to the developer. Of course, the department would want to say that he has agreed to surrender his rights back to the builder. but I would believe that that is not a key element of a service, and the compensation is not received as a consideration for that. Of course, there's also an argument to say that buyer one is not into the business of real estate, and therefore the supply is also not in the course of furtherance of business. And in most of the examples, the buyer one would be accounting for this compensation as capital gains. If that be the case, then one can say that the buyer one not being into business, not rendering a service to the builder, there is no liability towards payment of GST on these types of compensation. Pause here for a moment. There could be another way of structuring a transaction. There could be a direct resale agreement by buyer one to buyer two, and the builder might be just giving an NOC. He might charge a transfer fee for that NOC, and if the developer charges a transfer fee for the NOC, that would be liable for GST at 18%. The question here, which is really controversial, is that when buyer one resells the property to buyer two, while the property is under construction, whether buyer one is also liable for GST. We are not talking about the developer's liability towards GST, which we have on a conservative basis said yes, he is liable. But as far as the buyer one is concerned, whether he is liable for GST, again, to my mind, if you read Schedule 2, Para 5, it talks about two facets: construction, intended for sale, prior to completion certificate. So 3 facets. In this case, there is a prior to completion certificate, but as far as buyer one is concerned, he is not involved in construction. If he is not involved in construction, just a sale prior to completion certificate will not attract the rigors of the entry, and one can take a view that buyer one is not liable for GST, even though he might earn a profit. He might have invested 1 crore rupees and he might sell it to buyer two for 1.5 crores. Despite that, there may not be an exposure towards a payment of any GST on that type of a transaction. So this is as far as the secondary transactions between the parties are concerned. At a developer taxation level, of course, we keep on debating this aspect. We saw that in most of the cases, there's a blanket denial of claim of input tax credit. And a moot question which comes up is whether this blanket denial of input tax credit is constitutionally correct. There's a lot of debate which we can keep on going into, but for want of time, I don't want to take you through that entire thing. But yes, there is, according to me, clearly a constitutional challenge. If some builder developer would want to really take the bull by its horns, one can really argue it out to say that the condition prescribed under the notification 11 cannot really operate, because notification 11 is a rate share notification and not a credit eligibility. Further, when you go to section 16 and 17, the conditions and restrictions have to be prescribed. They cannot be notified. And we are aware of the difference between a prescription and a notification. More importantly, a rate notification cannot prescribe a conditional rate without any fallback option. So in that sense, there is a possibility to argue, but 3 years down the line, 19 to 23, 24, we are aware that today the law is more or less getting settled to say that yes, for any projects, you will start by assuming that there is no input tax credit available for residential complexes. Make no mistake, we saw in that entry, for commercial complexes, input tax credit is available. And therefore, if you are doing a mixed project where commercial is more than 15%, you will be eligible for a proportionate credit. That also we are aware, Rule 4243 has been amended to provide for an area-wise availability of credit to the extent of commercial complexes. The only question which comes up is, in case of a complex development project wherein there are, let's say, a few residential buildings, a few commercial buildings, you are told that you can claim input tax credit to the extent of the carpet area of the commercial complexes. If it is 30%, you claim 30% credit. If it is 40%, you claim 40% credit. But those who are into real estate would know that on day one, it is not easy to determine that proportion, because while there will be a singular project, the approvals are obtained in phases, and at times there is a dynamism involved. Sometimes you might initially take an approval for a residential and then convert it to commercial, or take a permission as commercial and then take it to residence, or maybe at some future point of time you might load additional TDR FSI and then use it only for commercial or only for residential. And therefore, throughout the project life cycle, you will find that this ratio of residential to commercial complex might keep on changing. And therefore, your eligibility for input tax credit, which is based on this ratio, itself will keep on changing. So how does one deal with it? Because, end of the day, you still have to, determine the credit on the basis of a ratio. So my suggestion in this case, of course, the law does not envisage this type of a dynamic scenario, which is a very commonplace scenario. I would believe that at each point of time when you are claiming a credit, look at what is available as a current benchmark. And based on that benchmark, calculate a ratio. And at a later point of time, if that ratio becomes favorable or adverse, you redo the adjustments vis-a-vis that particular project. And accordingly, keep on reworking the proportion based on the real scenario of what the proportion comes out. Another issue which is coming up, specifically in cases of leasehold properties, is entry 16.2 of notification 11, which prescribes the nil rate of tax for the land component where the land is obtained on a long-term lease. Now, essentially, because of this entry, at some places, the department is now starting an agitation to say that because this is an exempted service, therefore, even though you are doing a commercial project, let us say you're doing a 100% commercial project and everything is sold pre-completion certificate. In that case, despite everything being taxable at 12%, because of this entry 16.2, the department is saying that there is a value of exempted service and not carpet area driven, but a value driven reversal is required. Now, according to me, that would be incorrect, because if you really look at Rule 42, which provides for the provisional working, and for the 42.3, which provides for a final working, you will find that there's a clear dichotomy between a real estate development where the reversal is based on a project and a carpet area, as compared to all other cases where the reversal is based on a financial year and a value. Now, naturally, it's either or. You cannot have both. You cannot say that I will also require you to reverse based on residential commercial carpet area and also pre-OC, post-OC carpet area. And also at the same time, I will want you to reverse based on the value of exempt supply vis-a-vis the value of taxable supply. Because then both the provisions are dynamically opposite to each other and conflicting with each other. So in my view, that type of a dual reversal may not be required. And it's actually only the carpet area based reversal which will be relevant in the entire matrix. So with that basket, I would like to conclude my first part of the discussion, which dealt with the relationship of two stakeholders, the developer and the buyer. And we are aware that this was perhaps one of the simplest ones. We now go into an area which is perennially controversial, the relationship between a landowner and a developer. And when we look at this relationship, you will find that there are so many different types of arrangements which are possible between the landowner and a developer. And each time you find that there's some new arrangement also which is coming up, because this is naturally a high stake item. It's, of course, it defines the existence of a project in itself, because through this arrangement, the developer really gets a right to enter into the project. But at the same time, there are concerns not only from GST or tax, but from many other perspectives, both of the landowner and the developer. And therefore, there are different types of structures which keep on getting evolved in terms of the agreements and the arrangements between the landowner and the developer. We've tried to look at 5 broad types of arrangements, and I'm sure most of the activities can fit within one of those. There could be a mix and match also, but let's quickly look at the 5 broad types of arrangements. And the first one, of course, is a plain vanilla joint development agreement, wherein the landowner has a plot of land. Right now, we're talking of a free plot of land available, not something which is wherein there are structures or existing tenants or things like that. We'll talk about that slightly later. And he says that I want to develop this, but I don't want to invest money or take risks. So he picks up a developer. He wants a share in the profits in some manner. He wants an upside, but at the same time, he doesn't want to invest. As far as the developer is concerned, he also says, I don't have the money to invest in the land, but yes, I can invest in the construction and the other activities. And I can also take care of the marketing and the risks involved in the marketing. So both the landowner and developer enter into a sort of a joint development agreement. Now, again, there will be various ways of structuring this joint development agreement, which we will talk about in the next slide. But this is one simpliciter model of a development wherein you will be looking at a development agreement, an executed development agreement between a landowner and a developer. A variation of this is the redevelopment, where typically a cooperative housing society representing its members is the owner, landowner, and there are existing members who already have flats in that society. So the members and the society jointly enter into a redevelopment agreement with a developer, whereby the members get certain area free and certain monies also at some points of time. And the developer is able to monetize the balance extra potential available in the project. Now, of course, this has various challenges of GST, and we'll go into that. And that's where a self-redevelopment proposal also is something which is being canvassed, wherein the cooperative society actually would act as a developer and would, try to put the developer into the position of a contractor. There could be a case where there is a landowner, wherein there's a structure where there are existing tenants, and on an as-is where-is basis, the development rights have been given to a developer. In that case, there will be a redevelopment wherein there will be an arrangement with a tenant, there will be an arrangement with an existing landowner, and then there will be future sales of open property. And finally, there could be an encroached land wherein there would be a slum rehabilitation, and then you have an SRA also coming into picture into that entire process. Now, many a times we try to merge these different types of discussions, but essentially the structure of each of them is very, very different. And therefore, we need to bear that differences in mind when we go to interpreting the tax implications in each of those cases. Therefore, each of these 5 broad baskets become very important in discussion. But if we can, if we go into each of them in detail, we will never be able to complete the session. So what we are trying to do is we are trying to simplify this entire thing from the perspective of the landowner and the developer. And let's understand what is the supply by the landowner essentially. And there could be 3 situations of that supply. It could be a land simpliciter, wherein there's a conveyance given by the landowner to the developer. There could be a land which is partially developed also, maybe some part is done and then the landowner wants to exit the premises. Or there could be a development rights wherein the title continues to remain with the landowner. It's only a limited right of development which has been given to the developer. So typically from a landowner's perspective, the supply is either of a land or a partially developed land or development rights. In the return of this supply, the landowner typically expects one or more of the different types of considerations. A very simple model is the landowner says, I want cash. I think the answers are very simplistic then. Or he wants developed area, which he will use for himself. Maybe it's a large family, so he says, I want some cash, I want one flat each, and for everything else, you can keep on selling and you give me the cash. He can say, I want some cash, I want some developed area for myself, I want some additional developed area, which I will sell in the open market. So in that sense, he is also going to commercially exploit the area. So you have second and third bullet points, which typically in the industry, we use the word area sharing. Fourth is revenue sharing, wherein the landowner will say, okay, both of us jointly develop. You keep on selling. I will keep a control on what you are selling and what price you are selling. And I want a particular percentage of the gross revenue proceeds as my consideration. And finally, there could be a scenario where the landowner says, I want a share in the net project profits as a part of my consideration. So different types of considerations can be nomenclated against the supply. So essentially, this is where the entire transaction between the landowner and the developer will come into picture. Now let's, in that background, understand the GST implications at the landowner side. Now, if you look at it, when you look, say that the supply, because the GST is applicable on a supply. From a landowner's side, irrespective of what he gets back, either in cash or in terms of area, either today or in future, if he is giving a ownership right in land, clearly, I think Schedule 3 says sale of land is excluded from GST. I don't see any challenge on that front. Now, Schedule 3 does not talk about undeveloped or developed land. So long as there's a conveyance of even a partially developed land, I would believe that would also get excluded from GST. Now comes the third part, which is supply of development rights. Again, this is something which is not free from doubt, but if you go post 2019 through a notification driven law, we are told that a grant of a development right is subject to reverse charge mechanism under notification 5 entry 5B. Because it's reverse charge mechanism, landowner doesn't have to pay tax. The tax will be paid by the developer. Again, the time of payment of tax has been postponed to through notification 6 to the time of the completion certificate. So it's only at the time of completion certificate that the tax will be paid. The tax will be paid by the developer. However, a small caveat is that if it is for a commercial component and the amount is paid by way of a monetary consideration, the RCM is payable upfront. Now we are also told that in case of residential units, tax is payable only to the extent of unsold inventory on the date of completion certificate. So if the developer has sold out his entire inventory and paid the output GST on the sale of residential units, then essentially you will end up with a 0 RCM tax on this front. Everything will get exempted because of this notification, which gives that partial exemption in that case. As far as commercial units are concerned, tax is payable even on the non-monetary component, but you can prepone the tax so that you are able to claim the credit. And then, as you are aware, para 1A defines the value to be the first agreement to independent buyers. And that will be the value on the basis of which the value of the development agreement will be defined. And therefore, consequentially, the tax thereof will be defined. Now, of course, this is a conservative view where you will just pick up the notification and say that these are the notifications, this is the tax, all these taxes payable on the date of the completion certificate, except for monetary consideration on the commercial component. A possible view is to say the development right is as good as sale of land and therefore excluded. Further, as far as the landowner is concerned, the supply of development rights may not be in the course of furtherance of business. Also, the RCM notification, the way it is worded, it only covers transferable development right and FSI. And according to me, there's a difference between a grant of a development right and a transferable development right, which is a certificate issued by a government authority, which is transferable in the trade. So typically, when you undertake a slum development, you will be given a transferable development right by an SRA, or if you are constructing a parking lot, you might be given a transferable development right. Now that transferable development right is very different from a grant of a development right through a certificate, through a development agreement, because in this situation, there is no endorsable certificate or a transferable document. And therefore, one may try to argue that the RCM notification itself is not triggered and therefore GST is not payable. Of course, this will be litigative, and we are aware of in service tax, there have been decisions upholding a view that development rights are not subject matter of a service. So depending on the risk appetite, a landowner may like to take a position in this regard. So that is as far as the taxation of the landowner is concerned. We now jump to the other side of the matrix and look at the consideration by the developers and the tax implications in the hands of the developers. So as far as a developer is concerned, he would typically, as we saw in this slide, he would typically try to supply cash, share in gross revenue, or share in profits. All these three are monetary components. So he is acquiring a development right or a land, and in return, he is paying a monetary component either upfront or in future point of time, maybe even a variable amount. Naturally, when he is supplying cash, it's a transaction in money. That aspect cannot result in any GST implication. The question comes in the second and the third bullet point, wherein he is supplying some developed area for either self-use or further use. Now, when he's supplying some area which is either for self-use or further use, the department may contend that this becomes a barter. And because there is a barter, you are getting a development right, and in return of development right, you are giving a developed area. Therefore, not only the development right by the landlord becomes taxable, but also the sale of the so-called developed area by the developer to the landowner becomes taxable. A possible litigative view would be to say that entry 5B does not specifically deal with barters. And more importantly, even if you look at the consideration definition, the way it is worded, it does not very specifically cover barters. More importantly, entry 5B deals with construction for further, intended for further sale. In many cases, if especially the developed area is to be self-used by the landowner, like a redevelopment example, the construction is not intended for further sale. And if it is not intended for further sale, even the entry may not apply. So that is a litigative view which could be possible as far as a developer is concerned. A conservative view would be again to respect the notifications. And if you respect the notifications, there's a notification 6, which defers the taxation to the time of completion certificate when you hand over the possession. And then we are told, as per para 2A, that you will calculate the value based on the value of similar apartments sold nearest to the transferring of the development right, which is basically the first date of the transaction. First sale to an independent buyer would be the rate which will be interpolated here, and tax would be paid on the date of receipt of completion certificate. That takes us to a situation where the developer has provided these units to the landowner and landowner is further selling it. Now, as we talked about earlier, a possible view is that when a landowner resells those units to the end buyer, there is no liability towards GST because there is no activity of construction. In many cases, the landowner may also not be in business. So on those grounds, which we discussed a few minutes back, a view can be taken that on that resale transaction, the landowner may not be liable for GST. However, one of the conditions in the end rate notification somewhere enables the credit to the landowner if he is charging tax to the end buyer. And that rate notification condition somewhere brings in a thought process to say perhaps the landowner has an option to register and charge GST to the end buyer and claim input tax credit of tax charged by the developer. Now, of course, this suits everyone because what happens is if both the landowner and the developer are simultaneously selling the units while under construction, you don't want in a market a disparity that one party, when he sells his units, he is charging GST separately. So he might charge 100 plus 5. Whereas the other party, the landowner, says, I will charge you 105 consolidated. I will not charge you GST separately. Now that will create unnecessary confusion in the market. And therefore, most of the landowners in these types of situations would want to take that conservative view, register themselves, charge GST to the end buyer, and claim input tax credit of the tax charged by the developer. Now, one of the earlier slides we talked about saying that the developer can discharge the tax on the date of the completion certificate. But as far as the landowner on his resale transaction is concerned, he will have to discharge the tax liability on advance payments. And therefore, there will be a mismatch or a misalignment between the output tax and the input tax credit at the landowner's end. In this context, the developer may prepone his liability to the extent of sales done by the landowner and discharge the tax liability earlier, issue a tax invoice so that there is no incremental cash outflow at the ends of the landowner. And this would in fact bring in the required commercial parity between the landowner sales and the developer component sales. So I think that is an important facet from the business perspective. That takes me to the next structure, which is relating to the redevelopment of cooperative housing societies. And very simply put, if you look at the financial side of it, a developer, when he enters development projects, we are aware that yes, a developer will incur certain cost to existing members. They'll give some corpus to the society and the members. They will give some rent. They will give some inconvenience allowance, etc., etc. And the developer will commit to construct free area for the existing members, their existing area plus maybe 30% or 40% more. And against that, the developer receives a development right, and using that development right, the developer constructs a further building. Maybe he will incur a cost of 30 crores and pay to various contractors, vendors, and even the municipal authorities for getting the TDR and the other approvals. He therefore has incurred a cost of 10 crores and 30 crores, 40 crores. And against that, whatever is the extra area which he has developed over and above the free area given to existing members, he will sell to new flat buyers. Let's say he receives 50 crores as the sale consideration from new flat buyers. We are all aware that this 50 crores is liable for GST. It's his revenue. 10 crores and 30 crores are his costs. 40 crores, he earns a profit of 10 crores. This is a very simplistic financial model of a redevelopment. There's no doubt about the liability of tax on 50 crores. There's no doubt on the contractors charging taxes on the 30 crores, which they are going to charge to the developer. And also the fact that the GST so charged on 30 crores will not be available as a credit to the developer because of the no ITC rule, which we just talked about a few minutes back. The question which comes is, what about the free area given to the existing members? Is that also a barter? Is that also having the same principles which we discussed a few minutes back relating to a joint development agreement between a landowner and a developer? Or is there some different answer possible? Coming back to the entry, it talks about construction of a complex intended for sale to a buyer. So a very important facet which we need to understand here is that when the existing member is told that, look, you had 600 square feet apartment, under the new project, I will give you 840 square feet apartment. That 840 square feet apartment constructed by the developer for the existing member is not intended for sale either by the developer or by the buyer, by the member. In fact, it would be incorrect to say that an existing member is nomenclated as a buyer. Therefore, one may like to argue that this entry itself applies to situations where there are transactions with third parties and not transactions with existing members who already have units with them. Again, whether there is a non-monetary consideration itself is a question, because one will want to delegate this to say that a society or the member is granting a development right. But this grant of a development right is very different from a grant of a development right under a development agreement. If one goes through the redevelopment agreement, one will really find that a society has a much larger upper hand in the transaction, and there's only a very limited right of entry which has been given to the developer. In fact, most of those agreements clearly say that no development rights which are in the nature of a transferable development rights are given. So that is also one facet which comes into mind. One very simple analogy which comes is that essentially, if you look at this structure, one finds that the free area given to the existing members is commercially and business-wise funded by the new flat members. End of the day, it's not only the 10 crores and the 30 crores, which includes the cost of the construction of the free area. The entire amount of free area, the cost comes from this 50 crores. There's nothing beyond this which comes. And if you look at the definition of consideration, the consideration is defined to include payment by a third party. So isn't this a case where an existing member says that, look, you construct a property for me for a consideration to be collected from a prospective buyer? And if that be the case, there is only one consideration, which is 50 crores. And on that, the tax has already been paid. In fact, in the context of service tax, this type of an analogy has found a judicial acceptance by the Hyderabad tribunal in Vasanta Green's cases, where this is a celebrated case. Of course, there's another case called Ethics Infra from the Mumbai tribunal, which also talks about the same principle. Matter is right now in the Supreme Court, and based on the decision of the Supreme Court, one can try to analyze this situation. I would believe that there's a strong merit to say that cost cannot become a revenue. In fact, from a commercial perspective, this is just a cost, and the department's attempt to create dotted lines and deem a barter is perhaps not the correct way of interpreting the entire transaction. So this is how one would look at it. Of course, if you want to take a conservative view, you will treat this transaction as a barter, and there will be two taxes. The member of the society giving a development right. To the extent of unsold inventory, there will be a reverse charge mechanism. And to the extent the developer gives flats to the existing members, there will be a normal tax. Just like the example of a landowner and a developer joint development, which we talked about earlier. Similar principles one can conservatively apply if one wants to in this scenario. That takes me to the self-redevelopment. And as we know, the model here is simplistic. There is a cooperative society which enters into arrangement with the members to say that, okay, we will develop jointly ourselves only. We will find new flat buyers, collect 50 crores from them. We will appoint contractors, vendors, etc., pay 30 crores of cost to them. And whatever is developed is given to you free. Now, when this type of a structure happens, we need to have two important facets in mind. The principle of mutuality is dead. And therefore, the department might want to say that the CHS or the cooperative society is as good as a developer, and it is providing a service to the existing members, and try to interpolate the same GST implications like the earlier slide. However, the department will have to be cautious about this fact, because under the Cooperative Societies Act, the land always belongs to the society. Therefore, the members cannot give a development right to the society. As such, there's nothing coming from the member to the society. Again, depending on the type of the society which has been incorporated, the structure may also either belong to the society or to the members. If we go to some of the provisions of the Societies Act, you will find that the members merely own a right to occupy the premises. Of course, there is an underlying right in the ownership, but that is an underlying right, not a direct right. And therefore, on a strict interpretation, one may try to take a view that this type of a self-redevelopment is outside the purview of GST. Of course, when the 50 crores are collected by the society from new flat buyers, they would be liable for GST as normal course of action. That takes me to the next facet, which is relating to a tenancy redevelopment project. And your situation becomes even more complex. You have a scenario of a landowner. You have existing tenants. The land is owned by somebody, but there is a restricted tenancy right available to existing tenants. And therefore, when a developer enters into agreement, he has to allot free area not only to the landowner, but also to existing tenants. Of course, he will fund all of this from the new flat buyers, which will be taxable, no doubts about it. The transaction between the developer and the landowner, we've already discussed the earlier slide wherein we talked about the joint development agreements, and it will work accordingly. But now coming to the third facet, which is new in this model, is the developer giving free area to existing tenants. And here, the question which comes up is, while the developer has given a developed area to an existing tenant, the existing tenant has not given anything back to the developer. So therefore, because an existing tenant does not own any development right, the rights of development always lie with the landowner. Therefore, you cannot equate a landowner and tenant in the same matrix. Someone might be inclined to say the existing tenant is surrendering a tenancy right. But if we refer the permanent alternate accommodation agreements, which are entered into by the developer with the existing tenants, you will find that in many of those situations, the agreement very clearly says that there is no and it's only an improved challenges in life, and there So I think we discussed about the tenancy development before we really, I think there was some technical issue and I switched off for a minute. Now comes the other facet, which is slum redevelopment. This is even more complicated as compared to tenancy. And this is complicated for a simple reason that there are two more parties. Instead of the tenants, you have existing slum dwellers and there is a slum rehabilitation authority, SRA. The free area given to the existing slum dwellers is against a letter of intent with the SRA through which you get an FSI or a TDR. At times, the question which comes up is, for this transaction, who is the recipient of the supply? Is it the existing slum dweller because he is receiving the property, or is it the SRA because the letter of intent is issued by the SRA? A larger question which comes up is that this entire thing comes from a development control regulation. So it is more a statutory function. And therefore, there are lines of argument to say that perhaps for the existing slum dwellers, the free area given is not a subject matter of a supply at all. And if at all there is a supply, it's a free supply. Of course, it will have to be argued out, but that is a possible argument which one may like to look at. So that, I think, is a very quick roller coaster on the landowner developer taxation. And I think we'll spend a couple of minutes on this last leg, an important stakeholder, which is the government. And as we know, when you are looking at government, various types of payments are being made to the government. The first aspect being the FSI TDR. Somewhere we did touch upon it when we talked about development right. But as I said, there's a difference between a development right and an FSI TDR. A development right emanates out of an agreement through which a landowner tries to split his rights and give up only a development right. Whereas an FSI or a TDR generally comes out from a statute or from a development control regulation. And when we look at it in that manner, the question which comes is whether a transfer of an FSI or a TDR is liable for GST. Again, we go back to the same thing. Services means anything other than goods, very widely defined. And the exclusion restricts itself only to sale of land or buildings. And therefore, a conservative view would be to say that transfer of FSI TDR is neither of the above. And then through the notifications, RCM is applicable on the date of the occupation certificate, which we discussed. There has to be a tax payable and valued as per the first transaction with independent buyer. Tax payable only to the extent of unsold inventory on the date of completion certificate. This is the notification driven stated FSI TDR is a right in a land, and if it's a right in a land, whether it is excluded from the purview of GST. One can look at the Maharashtra Land Revenue Code, the regulation 34 of DCR, which defines the transfer of development rights, and various judicial precedents, one from the service tax itself, DLF commercial projects, and Cheda housing, of course, is a Bombay High Court decision, which all of this might somewhere suggest that this is a right in a land. And if it is a right in a land, perhaps one may want to invoke Schedule 3, notwithstanding the fact that there is a notification, specifically trying to impose a tax to an RCM in a circumvent manner. Again, the entire manner in which the notification imposes a tax, defers it to a future date, gives a conditional exemption to the extent of sold inventory. All of that, if we read it together, perhaps one will find that really you can't create a law in a manner like this. Because once you have granted an exemption, the question of triggering RCM does not arise. Of course, one will say that the exemption is given in a conditional manner. So if that condition is not satisfied, whether RCM will get triggered, all those questions are there in the way and the manner in which this entire entry is being developed. Now we talked about freehold land. We also have situations that government-owned land are given on a long-term lease, and there's a lease premium. It has its own checkered history. Whether it's liable for GST or not, matter was agitated by the Builders Association of Navi Mumbai in the Bombay High Court. Bombay High Court held that lease premium is liable for GST. Matter went to Supreme Court. Supreme Court dismissed the SLP. So to some extent, the observations of the Builders Association of Navi Mumbai become sort of a final law. Thereafter, there have been notifications wherein, as far as industrial construction is concerned, there's an exemption entry. As far as RERA-related transactions wherein the lease is for further development of residential or commercial construction is concerned, there is RCM applicable. As we are aware, we talked about the FSI TDR entry that also talks about lease premium. But again, of course, residential, it's deferred till completion certificate and it's subject to RCM. As far as commercial is concerned, that also is subject to RCM, but there is no deferment. So the entire monetary consideration, the tax will be payable at the first juncture itself. A derivative issue which is now coming up is if there is one Mr. X who has already obtained a long-term lease. Let us say he's built up a factory over there. And after a few years, he sells his property, which includes the lease, assignment of the lease for the unexpired period, as well as the superstructure and the sale of the ownership rights in the factory building. Whether there will be a GST applicable. Again, it's a matter which will have to be examined in an individual situation. But I think 2-3 things which come into mind. One is, in most of these examples, while we might say there's an assignment of lease, essentially what happens is the first lease is terminated by the government authority like MIDC or CIDCO, and a fresh lease for the unexpired period is entered into by MIDC or CIDCO with the third party or the buyer. If that be the case, then there is no assignment or transfer from the first lessee to the second lessee. Secondly, we'll also have to bring in principles of composite supply, because most of these examples, there would be a lump sum payment for not only the lease property, but also the superstructure thereon. The superstructure, clearly there is a sale of building, which is excluded under Schedule 3. And if that be the case, how do you value only the land component? And if there is no machinery under the law to identify and distinguish the land value from the superstructure value, in that case, the levy itself fails. So that is one more aspect which we need to keep in mind. Various other types of payments real estate developers and builders make to the government. In general, we are aware that services given by the government to a business entity, RCM applies. There are exemptions for specified services provided by the government. We are aware of those entries, municipal, any activity which is a municipal function under Article 243W is exempted. There's a transaction value, small value exemption of 5,000 up to 5,000 rupees. And then there are specific exemption entries. So you will take into consideration all those entries, and accordingly, you will have to end up deciding on the applicability of RCM on various payments made to government. This is, I think, from my side. And of course, this has been a little bit longer or faster than what one would have expected. But in view of the 85-90 minutes available, we had to go by this speed. If there is a question, we can take up those questions.
Yes, sir. Thank you very much for such insightful session, sir. So we have one of the questions which is put in Q&A session. Should I read out for you, sir?
Yeah. Okay. Okay. I can also go through it. Okay. So
Sure.
Let me just pick up one by one the Q&A questions.
Yes, sir.
So the first one is from Anand Chandak. His query is for an affordable house. Is it 60-90 square meter and 45 lakhs or only 45 lakhs irrespective of area? So it's a cumulative test. It has to satisfy both the tests. It has to be depending on the city, either less than or equal to 60 or 90 square meter. And also the value should be less than 45. It's cumulative test and not alternative. We have a question from Ankur. In case of purchase of TDR or development rights, which is going to be utilized in an RREP, how GST is to be charged under RCM? I think we did address this issue. So if you are going to utilize in an RREP, the first point which comes up is that there is an RCM applicable. So the tax will be paid by the developer. Another point is the time of supply will be the date of the completion certificate. So on the date of completion certificate, you will end up paying the tax. The third thing is you will pay tax only to the extent of the proportion of the unsold inventory. So if you have only 10% unsold inventory, then only a proportionate 10% of the GST will be payable. 90% of the GST attributable to the sold inventory will be exempted. The fourth question comes is how are you going to value it? In case of TDR or development rights, if you have a monetary consideration, that monetary consideration itself will be taken. If there is no monetary consideration, in that case, you will take the first agreement value with an independent buyer, find the rate of that and interpolate that rate in the development agreement and calculate the tax accordingly. So I hope these are the 4-5 steps which one needs to bear in mind, which we had talked about, and I tried to repeat that. And I hope that addresses the question, Ankur, you have raised.
Yeah, sir. There are still few very small questions. Can we take up, sir?
Sure,
Like
sure, sure.
one or two questions max.
Okay. But can I hope Ankur's question is answered and he's clear.
Almost questions are answered. There was one more one question which I found out was this is from Vijay Kumar, sir.
Yeah.
As the property is sold after GST, then no after obtaining OC, then no GST applies. But still, is builder required to obtain GST registration? If you could some.
Very important question. I can answer it both legally and practically. If you are restricting your facts to this much, I would say legally there is no requirement to obtain a GST registration. But let's understand that a builder enters into n number of activities. It's not just a sale of a property pre-occupation certificate which is taxable. He would definitely appoint a lawyer. And if he is appointing a lawyer, there is an RCM applicable on the payments made to the lawyer. At times, he will collect various amounts in the nature of maintenance. There would be security payments which you would be making. And there are different facets which come in. At times, when the property is under development, they might also put up some hoardings on the site which is under construction. And they might charge advertisement fees for that hoardings. So there are n number of activities which a builder does. And I'm sure one or the other of them would be liable for GST, which will trigger the liability requirement for registration. So theoretically, he did not obtain registration, but practically you will end up obtaining a registration because of some reason or not. I hope that answers his query.
Yes, sir. I think this was one of the very important aspect which a lot of people, all the builders faces, and this is by default will come into picture. And yeah, almost all the questions are revolving around the issues which we have discussed. Yeah, so I think Arpit sir, we can yeah we will put end to this session. But sir, on behalf of WRC, I would really like to thank you, and I would want all participants to give huge round of applause because these are very difficult matters, difficult issues, and sir, you explained it with so simplicity. The examples are so straightforward that we could really gain great knowledge from this session, sir. Thank you so much, sir. Thank you very much.
Thank you. Thank you, everyone.
So I think looking at the questions I think it was more like a real-time live help desk for all these queries, all these questions. So I think maybe we can think about having one such forum wherein these questions can come in and we could try and address them real-time basis.
Sure. Thank you. Should I log on?
Good afternoon, sir. Sunil.
Yeah, good.
Pooja, please
Good
continue.
afternoon. Good afternoon.
Yeah, so now is the second session of
Good afternoon.
Jitendra sir.
Gupta ji.
Jitendra sir is there?
Vande Mataram, sir.
Vande Mataram.
Gupta ji, namaste.
Yes, बोलिए मैडम.
Pinky madam, please continue.
Yes. Sir, welcome you in the second session of today's webinar. And we are fortunate we can listen you and your views on GST. We have CA Jitendra Atra, CFO Finance from Juno General Insurance Limited here also. Is there? Arpit?
Atra sir, may I request if you're around, if you can switch on your camera, please. I think he's not joined in yet. When he'll come in, we'll catch up.
Okay. So may I request Pooja to introduce our today's speaker, SS Gupta sir, please.
Yeah. So once again, good evening, everyone. And we really had a great session. The last session was really great and insightful. And now we are heading to another great session by SS Gupta sir, We all know him very well. That there's no need of introduction, but as a formality, I'll just say a few words about him. So SS Gupta sir is a chartered accountant, cost accountant, company secretary, and he's the author to the books. He has authored various books. Few of them, if I mention, that's GST law and practices, and GST on GST. There's one more very insightful book is how to meet your obligation by taxman, and he has been giving us he's giving us knowledge at various forums, whether it is ICI, ICWI, IMA, everywhere he's delivering his knowledge to all the members, and we are very very grateful to have him. First of all, we thank you that sir have accepted our invitation, and given the time to the fraternity so that we all can get some knowledge from him. So a very very warm welcome to sir, and we may continue, sir. I think he's yet to join probably.
No, no, I'm there.
Sir, you are there,
Sunil.
sir. You can start, sir.
My camera got stuck. I'm really sorry, sir.
Sir, over to you, sir, please.
Yeah.
We may begin. Sir, only thing is we had invited Atra sir, I think CFO sir, so with that he could address because this is that sector. But I think he's just facing some issue. Once he joins in, then we'll have a company. So please.
Okay. Thank you, Pooja, for nice introduction. And Arpit sir, nice to see you on camera. Very good. I always seen you physically, but now first time I'm seeing you on the webinar. Nice, sir. Friends, you just heard Sunil Gabhawalla ji on real estate. And now we have a topic of BFSI, banking financial sector is the main thing. Now this, like construction, like that way in GST, I must tell you, all the sectors are facing tremendous problems. Whenever the tax liability is there, everywhere, because the permutation combination of the business is so much that every business faces this problem. And sometimes the law itself is very complicated. Frankly, let me tell you. In fact, if you all remember, in one of the case, Justice Pardiwala, who's now a Supreme Court judge, he has mentioned in his order also that I can go to moon very easily, but I can't understand GST law so easily. So you can understand the complexity involved in GST law. That way, every taxation has that issues. Now we'll start with this background, and I must thank the institute because of institute's relentless effort to go on giving training to our members, that our members have been practicing in indirect taxes. You see, if you see the prior to 1994 excise and custom, hardly any member was practicing in excise and custom. But now when the 1994 service tax started, and really our institute started taking such training courses for new members, that now you find so many members are practicing in GST service tax and the GST now. Those who are practicing in service tax, it's easier for them to find out to practice in the GST because the statutory provision more or less match with the GST, with the service tax. One of the major difference which I can tell you is a problem for others is, you see, the GST law, the service tax, the excise, the custom provides for issuance of show cause notice for the purpose of recovery of the taxes which you are not paid or which you propose to be, credit is proposed to be denied. Whereas in VAT, we have hardly seen any show cause notice. In income tax, there is no procedure for giving a show cause notice. For assessment, when the assessment starts, you go on furnishing the information and you find that suddenly the order comes to you. He doesn't crystallize his thoughts why he wants to disallow any expenditure, or in VAT also, we have never seen. Therefore, you find that when the VAT authorities issue the show cause notice, there's hardly, it doesn't contain anything. I mean, the Supreme Court in time and again in case of Vrindavan privileges and all said, the show cause notice must give the basis of the entire basis on which the tax is proposed to be demanded. And that we have been arguing left, right, and center in excise duty and customs also, that your show cause notice does not give the basis. I must tell you, 90% of the show causes issued by VAT authorities will fail on that test itself. Leave aside your all the merit of the case. 90%. Today, if you see that High Court judgments, they're left, right, they are and center, they have been commenting that we don't understand head and tail of the show cause notice. This is not a show cause notice which can be issued. Anyway, that is one aspect to this. That is not my subject in this thing. Now we'll start with our presentation on the main subject of BFSI on this. This is the topic which has been allotted to me: banking and NBFC, stockbroking, insurance. And we will go to this. Let me tell you, like all other sectors, these sector also facing a lot of problem in the implementation and in this major problem which all these financial institution faces is, prior to this 2017, there was a facility of centralized registration, which means you can obtain a registration in a single state and you pay the GST or service tax for all the revenue earned at all the states. So like State Bank of India is there. They were having branches, 9,500 branches. They have obtained registration in Mumbai for all the 9,500 branches. All that you need to do is declare all the branches in your registration and then go on amending and deleting the name and address of the branches as and when their new is added or something is deleted. But now GST has made it this state-wise registration compulsory. Therefore, against one registration which is there, everyone has to obtain state-wise registration, which runs into 30-35. In addition to there are ISD registrations and all this. Financial sector is facing this major problem in implementing, in monitoring and implementing these for 30-35 registration and complying with the various provisions. Then let us see others. Now, financial sectors can be, I have just for my purposes divided into these 4 major sectors: banking companies, which will include the non-banking financial companies, and Reserve Bank of India. I mean, banking companies will include cooperative societies and all that also. The services provided by them, what are the problems, what are the provisions available. Then asset management company, because you have a mutual fund which is being managed by the asset management, AMC they call it, asset management company. And mutual fund is generally created by the trust, and which is entire thing is managed by AMC. Then you have insurance companies, both life and general insurance companies. Then you have health insurance also. There are some companies who are engaged in completely health insurance services. And then you have stockbrokers. Now these are the 4 persons. In addition to, you have a lot of financial sectors, is very wide sector. For our purposes, we have only concentrated on 4. You have portfolio management services. You have investment banking services. You know, there are so many other financial sectors are there. But for our purposes, we will discuss, our discussion will be restricted to this 4 only. Now, what is a banking company does? First, let us understand. Banking company provide different type of services. Some of them we are familiar with, like we operate the bank account, we get a checkbook, we get a demand draft issued, we get the remittance made out, and we get the other lockers facility, we get gold purchase and sales and all those things, bank guarantee. These are the normal functions of the bank. So what we have stated, bank providing bank guarantee, credit card, debit card, issuance of RBI bond, depository schemes. All these services are provided by the bank. In some cases, you may have a different companies like credit card. There may be separate company the credit card is issuing. You have a depository CDS services. There may be separate company who is issuing that. But banking company issue these type of services, and they levy charges. You will find that like you go to a bank where your RTGS is to be done, there is some charges being levied. Now charges are all including the GST amount. So you have the charges being debited to your bank account, and that is how the bank recovers the charges on that. Considering the various operations of the bank, there are certain facilities which have been granted. As I said, the banking companies, as I mentioned in my earlier this thing, the banking company have head office or corporate office at one of the branches. And as I said, the branches are available at all over the country. In all the states, it is there. Then you have head office and a corporate office, which is managing the entire show. Then you have zonal offices. Many of the banks and have zonal offices. So some 2-3 states will manage one, will have one zonal office. They are supposed to report to zonal office. Somebody may have regional offices. Then you have ATM, which can be owned by the bank or which can be given by third parties. The question which has been raised, I mean, again, as to the law itself make it very clear that each branches should be registered because you are providing the output services from that branches. So you need to register all the branches. When you are registering all the branches at different states, you need to operate, you need to specify one of the branch as a principal place of business. Kindly note this. Suppose you are registering yourself in Gujarat, you are registering yourself in Maharashtra, you are registering yourself in Rajasthan. One of the branch is you need to specify as the principal place of business. Now, whatever branch you specify as a principal place of business, at that person, that in principal place of business, the entire record of all other branches should be available. I mean, not physically, but accessible. So if suppose you are in Rajasthan, you are specifying one branch which is located in Udaipur as a principal place of business, the authorities, be it a DGJ authority, be it the registration, be it the jurisdictional authority or any authority, will always visit, unless they have other information, the principal place of business and would verify various documents which are required for their verification purpose. Now, this should be available at this location. What should be available? Suppose they want to see the revenue which has been earned by all the branches. So you should have a revenue for all the branches which is available. So if you have 100 branches in that state, all the 100 branches where they are located, what is the income they have earned and what is the different credit they have taken, all other expense details should be available at the branches. So while selecting the particular location as a principal place, you must specify this is available. This is all these records are available. Very often we have seen that in these branches, the trained people are not available who are doing GST, because all along this prior to 17, they have never been exposed to any taxation, or more particularly indirect taxation, because they have never faced VAT, they have never faced service tax, because service tax or centralized registration was there. So in head office only people are doing it. Some companies have started training some banks have started training the regional accountant at the various locations for the purpose of filing return and answering queries normally. But in most of the companies, we have seen that even today, it is being handled centrally. Now, Bombay files a return for Rajasthan, Bombay files a return for Uttarakhand, and Bombay files a return for Jammu, Kashmir, etc., etc. With the result, what happens is when a person visits, any authority visit to that location. So if you are, suppose your principal place of business is Udaipur, and you are filing return from Bombay, A person, when he goes to Udaipur and asks for accountant or a manager there, he doesn't know anything about ABC, about the return. But then it creates a suspicion, and then it creates a fear psychology and all that. So my request is that we must ensure that the person is at principal place of business, is aware of all the happening, all the payment, all the returns, and he has a copy of that in his computer, so that whenever the queries come, he is able to answer and he is able to handle the audit. I mean, audit handling may not be, he is able to show the records, and then whatever objections are raised, that can be communicated with their head office. And finally, if head office wants, the consultant can also communicate and discuss with them. So that's the first thing. The other thing which comes up is, you have ATM at each location. There are so many ATM which are available. Technically, nowadays all cash withdrawals, 99% of cash withdrawal takes from the ATM. The question that comes up is whether ATM is required to be registered with the department. The FAQ, they have published FAQ. I mean, which I don't know what entity it has, but anyway, in FAQ, they have stated that anytime the ATM is not required to be is declared as an additional place of business. Notwithstanding this, in the past, so many times, so many cases, we have seen that department has sought to deny the credit which has been availed at the premises which is required to be, which is not declared to the department. I mean, although at tribunal level, we have always succeeded in such cases on the strength that these whatever input services have been used in the location, they have been utilized for the purpose of rendering an output services. For example, in ATM, you have a security person, security agency. You may have a maintenance who's doing the maintenance of the machine. You may have the electricity expenses. You may have the rent expenses there. Now, all these input services credit you are taking in the main branch with whom the ATM is attached. And that credit department can deny if the ATM is not declared. But because of FAQ and because of the fact that ATM is always be used for only two purposes, either withdrawal of the check or deposit of the cash, withdrawal of the cash or deposit of the check. Both are used for the business purposes, and therefore the credit will be allowed to you. So this is about the registration on the banks. The banks. Now banks are also required to obtain input service distributor registration. Now this will be multiple registration. One is, as I said, the corporate office is there, who oversees the functions of all the branches. In a sense, they have control over the zonal office or regional offices, and then zonal or regional office will in turn have a control on the various branches. So as an input service distributor, you must register and distribute at each location. You must see that the expenses which are input services which are rendered by third party, but which is for all these locations, and that must be registered in ISD. That while you are booking as an expense, you must provide the registration of ISD. Some of the examples which can be given is, say, auditor services. Statutory auditor does the audit for all the locations, which includes all the places, branches. So he does the audit of record of the Rajasthan, he does the audit of Madhya Pradesh, he does the Tamil Nadu, Hyderabad, everything he does. And then the GST which he charges. The contract between the auditor with the auditor may be by head office. Head office located in Mumbai, auditor located in Mumbai, but he does the audit for all the records. So he may charge CGST, SGST, and then credit will be available in ISD. ISD should distribute that credit to different locations on the basis of turnover. For example, you may have a centralized consultant. So one of you can be a consultant by advising for all the locations. then that service of GST charge on that should also be available. Like this, one should identify the expenses which are incurred by the service provider for all the locations, but for which credit is obtained in head office. See, this is very important. We have seen number of times the expenses which have been incurred by the company, credit has been taken at one location, be it Maharashtra, be it Delhi, or be it Madhya Pradesh. And major problem comes up in advertisement. So you have, suppose, a logo, SBI logo is there. If you are only advertising SBI logo everywhere, then that you cannot say is only for Maharashtra. It is all over India. If you are sponsoring, say, any cricket match, IPL is going on now, you sponsor IPL. The benefit of that IPL sponsoring accrues all over the country. It is not restricted to any particular state. You may have sponsored a particular team in Mumbai, India, but you can't say the benefit is restricted to Mumbai only or Maharashtra only. So like this, you must major advertisement expenses which you incur, you must identify that if their benefit pertains to all the locations, you must tell the service provider, supplier, that you charge us the invoice on the ISD, and the credit should be availed in ISD, GST 6 and all that. And then you must distribute that credit. Please, if you take the credit only in one state, the state officer will, when he comes, he will come and try to deny you the credit on the ground that you are not entitled. Only to the extent of Maharashtra turnover that he will do the allow you the credit. For all other turnover, he will say, look, you should distribute this credit to others. This is one of the major problem which some of the companies are facing, be it not in many of the financial sector also, including other companies, because nowadays what happens is, if you look at this, whenever this PE funding is there, the advertisement is done left, right, and center. So you find the bombarding is done, and then once you do the advertisement is gives you a TV advertisement, gives you benefit all over the country. But people, because it only CGST is charged, that the CGST is charged, then the credit is taken only and the then the next question which comes up, bank has a unique thing. See what happens, there is a ratio, credit ratio, which is between exempted supply and the taxable supply. So between exempted supply and credit is required to be distributed between input used for taxable supply, input services used for taxable supply, and input services used for exempted supply. Interest is one of the factor which is there with the bank, which has been exempted right from payment of tax, right from service tax era, and which continues to be there in GST also. If you analyze the bank income, nearly 95% to 96% of the amount of income is earned from the interest. And that is on the loan. But to give a loan, the bank is backed up with the various accounts of saving bank, current account, recurring deposit, fixed deposit, so on and so forth. Only when you have the bank, because the Reserve Bank has got the statutory SLR ratio, and they determine based on their deposit of this, how much loan you can grant to the various companies. The ratios are fixed up. Now, after you give a loan, there is hardly any amount activity which you are required to do for the purpose of earning interest. It's mere calculation. Utilization of loan is there, and then the calculation of interest is there. But to give a loan, you need to have operate the saving account, bank current account, fixed deposit, and recurring deposit, and all lockers and all that thing. Now that activity is a major activity of the bank, and therefore the input and input services are mainly consumed in that activity. It is not consumed in the earning of interest. Therefore, the question which has come up is that if 95% of my interest is exempt from payment of GST, so if I go on a proportionate basis, then my GST income, my credit of 95% is denied to me because of a ratio business. But fact is that I have to do a large amount of my input services are used for the purpose of operation purposes, and therefore the credit should be available to me. Based on whatever data which the department had, they decided that 50% of the tax amount will not be allowed to you, credit will not be allowed, but 50% of the credit will be allowed to you. Now a question come up is, when FAQ, in some of the business, you don't need this kind of activity, like credit card, like bullion business. You buy gold and sell gold. So why should I restrict my credit of to 50%? Then this was represented to the department, and they said, if you want, you obtain a separate registration for this vertical of business. So you operate separate business for a bullion business. You operate separate line of activity for your credit card. You can do that. So you have if bullion business, suppose your head office is in Bombay and your bullion business also in Bombay, you can obtain 2 separate registration for Bombay and for the bullion business and for your normal office business. If your credit card also located in Gujarat or Chennai, you can obtain a separate registration in Chennai for credit card purpose. Once you obtain a separate business, registration for this, for other business, now there is a clarification which says that then, because you are not accepting a deposit in that business, that 50% of the credit is not required to be disallowed. You can then go on, depending on the income of that vertical, you may have to reverse the credit. What it means is not that your company may be one, but because of deeming fiction created under Section 25, you can obtain a separate registration for bullion business, for credit card business, and then you need not obtain the restriction of availing a credit on 50% will not be applicable to you. You can then go on to the normal route of reversing the credit only to the extent of supplies which are made, which are exempt from payment of tax. So this is another this thing which you have to keep in mind in registration. Now this is what about the registration. You have place of supply. You have section 12.12 and 12.13, which is there. 2 sections are there. Now you must remember that 12 is applicable when both supplier and recipient, section 12 is applicable, both supplier and recipient are located in India. And if supplier or recipient, any one of them is located outside India, then you have to look at section 13 for the purpose of determination place of supply. Now here, the place of supply and banking business is the location of the recipient. If the location of recipient is not available, address is not available, then the location of supplier. This rarely happens. But to explain this, suppose you are located in Bank of Baroda, you are located in Baroda, Gujarat. A customer from Kolkata applies to you for a loan, and the loan is sanctioned. The bank is located in Mumbai, customer is located in Kolkata, West Bengal. The location of recipient is West Bengal. Therefore, the place of supply is West Bengal, and Baroda Bank, whichever charges they will charge IGST to them. So this is the importance of this. However, what you must remember is generally, we open the bank account at the nearest place. But you see, some of the places which are located in the border area, like Delhi, Gurgaon, now you find many persons who are traveling from Delhi for their office, business office located in Gurgaon. So they may open the bank account in Gurgaon. They will provide the address of Delhi when they open the office, when they open the account in any bank in Gurgaon. Now there the bank has the register. Bank is located in Haryana. Gurgaon is in Haryana, but the customer is located in Delhi. There the bank should charge IGST for all their expenses which is charged on them. You need to be very careful when, if your branch is located near to the place, border area of a state territory or union territory location. This more particularly happens in some of the Mohali and Chandigarh, very close to each other, like Vapi and Daman. Daman is a union territory. Vapi is in Gujarat. Now these locations, if you are operating a bank account there, if you are managing the bank there, then you need to see whether GST is to be charged or IGST is to be charged. This is the thing which you must remember while you're if you are auditing the branches which are located in such places which are close to the borders, state borders. However, there is some problem in customers in section 13. The place of supply, if the service provider and service recipient are located in a different countries, not located in India, then this place of supply is determined by provisions of section 13, and as per section 13, the services supplied by a banking company or a financial institution or a non-banking financial company to account holder, the location is the location of supplier. That means where the bank is located. The bank is supplying the services and it is being done. Therefore, place of supply is the location. Now, what is account means? Account means an account bearing interest to the depositor and resident, non-resident external account and non-resident ordinary account, and includes non-resident external account. If the account is the interest-bearing account, then the tax location of supplier is the place of supply. Now this happens mainly in different type of accounts. You know, many banks open account in with the Indian bank or vice versa also for the purpose of providing a remittance to customer in that country. Let me explain this example. Suppose you have an export, you make a regular export to Bangladesh, and your importer in Bangladesh deals with the X bank in Bangladesh. The customer has an account, your importer has an account with the X bank, and he tells the X bank that, look, you please remit amount of 50,000 rupees to Y person in Bombay. Now that bank, X bank, will say open account with State Bank of India, and sometimes the X bank himself has a branch in Bombay. Now he remits he informs the branch in Bombay of X bank, please give 50,000 rupees to this person. Every time X bank can go on saying this, and the X bank in Mumbai will remit the amount. You can imagine, for every remittance which is made by Bombay branch to the various exporter, the remittance cost of the X bank in Bangladesh will increase. Therefore, what it does is, it keeps 10 crore rupees with the Bombay, and this is an example I'm giving you, with Bombay branch of X bank. And he says, this is a deposit made to you. I will not tell you that you remit 50,000 to A, 25,000 to B, 10,000 to C, 1 lakh to D. I will just give an email. And on that basis of email, you please remit this amount. So he doesn't go on doing this transaction every time. And therefore it keeps a deposit. One way is an account. There's no question that X Bank Bangladesh has opened an account in X Bank Mumbai. If such deposit of 10 crore which is made, if it does not bear interest, then it is not an account as per the definition given in explanation A. It says bearing interest. That's the main thing. But if X Bank in Mumbai gives the interest, maybe 0.5%, maybe 1%, maybe whatever percent it is, to Bangladesh Bank for deposit which they have made, then it will be considered as the account as per the explanation A. And therefore, place of supply will be for services provided by X Bank in Mumbai to X Bank in Bangladesh will be Bombay, will be India, and GST will be paid. Now you need to be careful. Now this is one example I gave you. This happens in banking industry, the bulk remittances are made from outside India. Practically every bank existing in the world has one or the account correspondent in India or other location or other countries, so that the customers there can receive the remittance or can make the remittance easily. There's no interruption in this thing. But as far as we are concerned, what we need to see whether it's a service amounts to export of service or not, that we need to look at this. And of course, we have one more, although you may receive the tax amount in the foreign currency, services amount in foreign currency, but yet because place of supply may be India, and therefore the export may not be, it may not be considered export of service. We have other problem. Is that it's the same branch, if the same company is there, then also it will be because of you are not meeting the requirement of export of services. This is a clarification from the CBEC. It is given in the context of service tax, and this clarification will be applicable even in GST, because the words used in the definition of account is identical to the what is now in GST and what was available in service tax. So these clarifications may be are very useful for this purpose. You can look at the clarification, but this is what we just explained to you on this topic. Invoicing. So you have seen registration, you have seen place of supply. Some relaxation has been given to the bank for the purpose of invoicing. You can imagine if the bank is to issue the invoice for each and every transaction of charges which they have had, it will be an unnecessary documentation, and bank will not be able to upload their invoices in the system, because crores of account, lakhs of transaction in many accounts, and therefore for each time to issue the invoice is very difficult, and the amount is also very small. Therefore, there are two relaxation. One is that the bank have 45 days have been given. Normally, as per section rule 46 and section 31, the 30 days time limit is provided to the bank, to the service provider, for the purpose of preparation of invoice from the date of supply. But banks have been given 45 days. It has its own problem. And the second is that they can issue the invoice on a monthly basis. Not need to issue the invoice on each transaction. If the banks nowadays, you have seen this, that the credit is you can take only to the extent this amount is reflected in 2B, and 2B amount gets reflected only when the supplier has uploaded the invoice in the system with your registration number. You can imagine, unless the invoice is issued on every 30 days, the credit will not be reflected in 2A or 2B of the recipient. And after receiving, if you issue the invoice in 45 days, you will be able to upload the invoice in the second month. Because the law very clearly says that invoices which are uploaded by 10th only will be transmitted, and they will be considered for the in the recipient hand, and they'll be only considered for the process credit. Now, if you do the invoice in 45 days, the 10th month is gone. You then will get in the next month. So the recipient will get the credit late. Mismatch will be a problem. Therefore, it is always advisable, with now the technology available, so much of technology available, bank can very well prepare an invoice on a monthly basis. Nowadays, there is no manual accounts which are being kept. Almost all the accounts are on the net banking or on the electronic mode, and it can be calculated. The charges which even David have can be very easily calculated on a monthly basis. And then, therefore, it is advisable to issue, although the law permits for 45 days, advisable to issue the invoice by the end of the month and upload it in the system. The other relaxation which has been given is that after the charges have been levied, you can issue monthly invoices. And monthly you must issue the invoice and upload it. We are facing so much problem in the availing of the bank account, credit for the bank charges. Because if you give a one amount of say X, 5 crore is the bank charges which has been levied during the month of March 2023. Now to substantiate that 5 crore, unless there is a backup available, it becomes very difficult for the auditor to satisfy the departmental auditor that this is the charges which have incurred. And some of the charges may be related to exempted supply. Then you will need to reverse that credit for that purpose. So all these problems you are facing, unless each transaction wise charges are attached with such an invoice, it creates an issue for the purpose of availment of credit. The other relaxation which has been given is that, cross charges purposes, whether cross charges to be made or not, that itself is a question. But anyway, when the cross charge to be made, they have given that it can be done on a quarterly basis, and the invoice you can account in the quarterly basis. But that itself is a question mark that I will not go detail much. So this is invoicing. Input tax credit, we already dealt with that 50%, and the other one you have available. That in the banking companies or NBFC or financial institution can have the two options for the purpose of reversal of credit for exempted supply. As I mentioned to you earlier, interest is a major exempted supply. If you take 50% of the credit on input capital goods and input services, then you need not follow section 17(2) for reversal of credit. For proportionate reversal of credit, you cannot follow the formula provided in 42 and 43. However, if you don't want to do for interest this calculation 50%, and you have a full credit, then you must follow the formula laid down in rule 42 and 43. Whatever option you exercise, it will continue for a complete financial year in this. Now, difference here is basically, you see, if you are earning as I mentioned, most of the banks were engaged in granting a loan. Their interest income of 90-95% is of interest, and therefore that will be exempt from payment of tax. However, if you are not in the business of loan, if you are only licensing here or ensuring that the loan is given by your parent bank, maybe located in Japan, maybe located in Hong Kong and all those places, and you are only doing the various work, legwork here to ensure that the customer finds it easier to comply with the various provisions, various requirements of the banks located outside India. And then your earning is not of the interest, and then you can follow the other route on this. But anyway, whatever you want to follow, the option is available for one financial. During financial, you can't change it. Further, it is provided, as I said, the cross-charging is to be done. If you have taken a credit 50% in the first stage, so then again you cross-charge that credit to other person, other location, then the second provision provides that look, again 50% will not be applicable. What it means is, suppose you have a head office in Bombay for an X bank, and the head office charges, makes a cross charge of the services provided to the different branches located in, say, Madhya Pradesh, Tamil Nadu, Andhra Pradesh. Now you already taken credit of 50%. If you again cross charge to that location will receive the cross charge invoice. It need not take 50% of credit. It can take 100% of credit, because already you have reversed 50% at the time of initial availment of credit. So again, second time 50% is not required to be taken by you in this, and hence the that company can take that bank branch can take 100% of this credit. However, whatever credit is input, service input, or capital goods are received by that branch, other than this cross charge, their formula 50% apply. Suppose your branch located in Chennai has a 50 is on rented premises and rent is being paid there, then that rent only they can take 50% of the credit. And that formula will continue into this. This, as I said, option of exercising 50% and going for a normal period, normal route of reversing the credit is available for each registration separately. You can offer 50% in Maharashtra, and you can offer the normal reversal in Tamil Nadu or in Andhra Pradesh. It is up to you. The option is up to yours. But having exercised option once, you have to continue with the same option in the financial year. That we already clarified, that once the bank has taken 50%, then no need of reversal in this thing. Valuation. Normally, valuation of the banking transaction does not create much problem, because whatever you charge to the customer, that is shown as a debit in debit in the bank account, and that amount forms the transaction value on which the tax is payable. However, the government very often, in order to promote various things, goes on giving subsidy, goes on giving the other incentives, and that incentive and this needs to be seen whether that is to include value or not. The government has started giving to promote rupee debit card, low value Bhim UPI transaction. They have started giving the subsidy to the banks. They have told the bank that you will not charge any amount to the card holder, the acquiring bank. Normally, as you are aware, in the debit card and credit card, the merchant have to cough out 1.5% to 2% whenever the amount is received from the credit card or debit card. The reason for recovering 2% from the merchant is to ensure that the amount is taken for service charges of credit card and this thing by acquiring bank, by issuing bank, and by the bank, by the agency who is making the settlement of the transaction. This is a normal system. But however, the government wanted to promote the rupee debit card and low value Bhim UPI, and therefore they have said, because in order to see that the cash transactions are reduced, that the government has said, you don't told banks that you don't charge it, we will give you by way of secure subsidy to them. The question which has come up is whether it's a subsidy or it's an incentive, is a transaction value, whether GST is payable or not. And ultimately, it was clarified by by the GST department that by circular number so and so, that such amount which is paid by the MEIT is nothing but the subsidy, and no GST will be payable on such amount by the bank. Now, many banks have paid that, amount. And if you have paid that amount, you will have to claim the refund for the same within the time limit prescribed under section 54. That is 2 years you do for this. Now we come to some of the issues which are come up in this thing. First, the bank also assign various debt to asset reconstruction company. You see, very often bank, what happens is that bank gives a loan. When the loan is given, the charges are being recovered. The application charges, processing charges, so many charges, mortgage charges, all these are being recovered. But after the loan has been given, only interest is recovered, and which is interest is exempt from payment of tax. Your money get blocked. If the same amount you recover, you pay, go on giving 10 loans, 15 transactions, 20 transactions, you are able to recover more charges from the banks. And therefore, what the bank does is that once they have, suppose they've given the loan of 1,000 crore or 2,000 crore, then they look for an asset reconstruction company who can purchase these 1,000 crore loan from them and then go on recovering that loan. These ARCs then look for the various companies who are willing to invest in that ARC, and when the amount is recovered from the customer to whom the loan has been given, that the amount that those who are invested is there, they are repaid with certain interest. So generally, bank assign this debt to ARCs. Question that comes up is, and the process is that bank first identifies which debt is to be assigned, what security is available, and what is the payment by these borrowers. Are they making regular payment or they're not making regular payment? There's all these banks give the detail. On this basis details, the rating agencies rate the loan recovery percentage, A, B, C, they classify, and then they value the amount of loan, and which is given by the ARC to the bank again. The bank gets the fund, which they can again lend to others. As I said, explained that when the bank lends again, they will be able to recover more charges. The processing charges, form charges, and mortgage charges, and all these are able to recover. Their income increases. And ARC also then is able to make investment, earn interest on the their investment. So this is a normal mode. The question which has come up is very often is whether on this ARC purchased a loan is any GST. It's a transaction money. You give a loan, you get it rated by the rating agency, and that amount is paid by the ARCs. So you transfer a loan, your ARC pays you that amount at a consideration. There's no supply of any service. This is a transaction money, and therefore no GST is payable. However, normally ARCs do not have the recovery mechanism. Therefore, bank goes on helping the ARCs on recovery mechanism. They go on recovering the amount, and the bank acts as a recovering agent on behalf of ARC. The bank ARC pays them the recovering charges, and that amount is the reverse charge the tax is payable. But on a simple transaction of the assignment of loan, no GST is payable. Then interesting thing is services provided by Reserve Bank of India was exempt from payment of tax till 17/7/2022. So Reserve Bank of India provides different type of services, and that has been exempted. There are two things we must remember is that in GST, you pay the tax as a supplier of service, and that Reserve Bank of India also supplies the service of clearing agents and all that, clearing agency and all that. Then Reserve Bank of India also gives a bond of the issues, the sovereign bonds and all that. Gold bonds are issued. They have been all exempted till 17 July. However, Reserve Bank of India has created so many subsidiaries for different functions. For example, Clearing Corporation of India, CCIL it is called, that has been created as a platform for various purposes like granting CBLO, collateral borrowing lending operations, foreign exchange operations, foreign exchange, stock exchange type of thing. Now this CCIL is a subsidiary of Reserve Bank of India. Whatever services provided by subsidiary of Reserve Bank of India, that is not exempt. What was exempt is only the services provided by Reserve Bank of India. Similarly, you have Deposit Insurance and Credit Guarantee Corporation, DICGC. Deposit insurance, what it does is all the banks which have deposit up to, I think it was earlier 1 lakh, now it is into 2.5 lakhs. The banks are required to insure the deposit with the DICGC and pay the insurance premium to them, to these DICGC. They charge GST on the insurance premium which is paid. In case the bank fails, now this is a mandatory requirement. Even State Bank of India, Bank of Baroda, Citibank, HDFC Bank, every bank is required to obtain this insurance. No bank is exempt from payment of tax. So even, payment of obtaining insurance. These services are provided by a subsidiary of the bank. They are therefore not exempt from payment of tax. Reserve Bank of India also, whenever they have received services from outside India, they are not exempt. They are required to pay tax. Now, of course, their own services also, the Reserve Bank of India. You see, very often, if you go into detail of these services provided by Reserve Bank of India, the Reserve Bank of India gets the work done from their various nationalized bank or various private banks. For example, running a clearing house. That's basic function of Reserve Bank of India. But Reserve Bank of India does not have offices all over the country. It has offices in various cities like Mumbai, Delhi, Calcutta. There it runs the clearing house themselves. But if you go to small cities like Pune, Bank of Baroda or Surat or this thing, they do not have the big offices in various places. So therefore, what they do is they appoint certain bank to run these clearing houses. Like in Gujarat, they may appoint Bank of Baroda because they have major branches in Gujarat. In South, Canara Bank may be there, IOB may be there. Now these banks provide services independently. One cannot say these services are provided on behalf of Reserve Bank of India, therefore it is exempt from payment of tax. And that tax being charged by them. So point is, after 17 July, there's no question. Earlier exemption was only to Reserve Bank and not to subsidiary of Reserve Bank. Then the third question, payment of tax on bank charges laid by foreign bank. This is a big question which is going on since service tax. The department has been, whenever you send the export bill for the purpose of collection of the amount, the bank charges are levied by the collecting bank located outside India from the customers. So if you have sent the bill for $1,000, say 80,000 rupees, you get in your books of account 75,000 rupees. 5,000 is the bank charges levied by the Indian bank, with your bank, and by the foreign banks outside India. So if you have sent through State Bank of India to Citibank, Standard Chartered Bank located in UK, then Standard Chartered Bank UK will deduct some amount, say 2,000 rupees, and you say State Bank of India deduct another 2,000 rupees. So 4,000, and you get the credit of 76,000 rupees. Whatever deduction is made by the bank charges for State Bank of India located in India, say 2,000 rupees, on that State Bank of pays the charges. But 2,000 rupees which is remitted to the Standard Chartered Bank UK, nobody is paying a tax. Department has been demanding from the exporter, and now consistently tribunal has held that the exporter is not the recipient of service. The recipient of service is rightly, it should be a bank, in our example, State Bank of India, Bombay, and they should pay the tax on this two amount and recover in turn from the customer in this. However, the demands have been raised on the banks also, and demands have been raised on the customer also in service tax. Let us see what they do in GST, but they should rightly exempt the tax, such payment of tax, because ultimately it is being borne by the for export purposes. Anyway, that we leave it as it is. The tax rightly should be payable by the bank and recovered from the customer. You have reverse charge mechanism. Now, this reverse charge mechanism in case of banking and other services is for recovery agent. Normally, we understand recovery agent, a person, two types of recovery. One is that you continuously go on reminding the person that, look, your installment is due and you please pay. And the person pays it. There is no due amount from him. So he is required to pay every installment on 10th of the month. You send him a reminder on 5th of the month. You send him 7th of the month. So he is ensured that on 10th of the month, the amount is paid. That one cannot classify as a recovery agent because it's just a reminder to do this thing. Collection agent one is called. But if the person is not paid for 2 months, 3 months, and amount becomes overdue, in such cases, you go on reminding him, you go on writing letter to him, phone call, maybe legal notices, then whatever legal further processes to be done. And that is being done by the recovery agent. Personal visits, all these activities are being done by recovery agent, and recovery agent does the recover some amount either on a fixed basis or on the success basis. The GST on such amount is paid, the commission paid to recovery agent is payable by the banking company and non-banking financial companies. As long as you can identify the person who's doing this activity, there's no problem. But nowadays, with the improvement in technology, what has started happening is that these platforms also doing the same activity. So you have so many platforms who are doing the activity of arranging for loan. In a sense, they have a form put up in the platform. They help you in filling up the form, processing of a requirement of the form, and then finally, after processing, they send the form to the respective bank for the purpose of approval and disbursal and all that. They also undertake that if you are not paid the amount, they will, reminding you on the payment of installment on the due dates. And if you are not done this, then they will send you SMS, and the amount becomes due. They will send you SMS, they'll mail you phone call, they will send you letters, email. Now, this is exactly what a recovery agent does. They perform all the services which a recovery agent also performs, and therefore, their services is equivalent to recovery agent services. And hence, the GST is payable on the reverse charge by the banks on this. The dispute arises, the platform person is not agreeing to the such mechanism, because once the payment tax is paid by the recovery, by the recipient of services, then it is as per section 17(2), it is considered as an exempt supply. And once it is considered exempt supply, then the taxes, the credit is required to be reversed by the platform, and which becomes a cost to him. That's it. There's a problem which is going on the recovery agent side. And these are some of the services which are rendered by the bank, and issues which are involved there by banking and NBFC companies. And now after the banking company, we move to the next stage, which is the mutual fund. And this, see, mutual fund, you all know that you see so many advertisement of the mutual fund. are created by way of forming a trust. So you have Birla Mutual Fund, which is a trust is there. And you have asset management company. In short, it is called AMC. The trust is managed by the trustees. It doesn't have any employee. It doesn't have any person. All the activities, only trustees are there. All the activities of the mutual fund is managed by the AMC. The activity of raising of fund, activity of appointing agent, advertisement of the fund, disbursing the amount, investment of the fund, etc. Sorry, investment of the fund in different scheme, and all the activities or declaration of the NAV value and all that is done by the AMC. And AMC charges, I mean, there is some SEBI guideline for the purpose of charge being levied by the AMC. But AMC, when it charges to fund the amount which is there, it recovers the 18% GST, and which is being paid by the to the department. So it is like a management of the company. There's a separate management of the company, and a manager is there, and the manager appoints gives the remuneration on which it pays the GST on that. However, this is going on. There's no problem. The SEBI has issued circular in 2018. Now, as I said, the commission to mutual fund agent was being paid by the AMC and ultimately was being recovered from the fund. However, SEBI informed that a commission to the mutual fund agent will be paid by the fund directly and not by the AMC. The rest all expenses of advertisement, raising funds, etc., will be done by the AMC, but the commission which is paid to the agent, you must be seeing mutual fund agent who comes to you very often for the purpose of investing in the particular fund. They said that, look, the amount will be paid directly by fund to the agent. With the result, AMC will not pay them. Now, the 18 circular was interpreted by department to say that this is a clarificatory in nature, and this amount, the services rendered by the agent, was always received by fund directly and not by the AMC. So whatever commission is paid by the agent, paid to the agent by the AMC is not the recipient of services, and therefore AMC cannot claim the credit. As I explained to you earlier, that the AMC were paying the amount to the mutual fund agent. They were taking credit of the same, of the GST being reimbursed to mutual fund agent, and they were including that commission as a part of remuneration and charging to fund, in which they are paying 18%. But department has taken an objection saying that AMC is not entitled for a credit on the ground that they are not the recipient of fund, and the circular of 2018 is the base for them. It is department's contention is that this circular says that the services are received by the fund directly, and since you are not recipient, you cannot claim the credit of this. This appears to be far-fetched. Once the GST is reimbursed to mutual fund agent, and GST is again, that amount of expenses which is incurred by the AMC is charged to the fund, and the fund has paid GST on that. Then the question of there's no credit left with the fund at all, AMC at all. Therefore, there's no question of reversal of credit comes into picture. First of all, the entire, as I said, there is no fund does not have any employee or anything which can deal with the mutual fund agents. Therefore, every activity is done by the AMC. However, because of this circular, the amount is which is collected on the in the account of the fund, that amount is paid to the commission agent, mutual fund agent, directly by the fund and not by the AMC. This investigation is going on by the department, DGJ department, and as of now, no show cause notice have been issued. But however, the department is pressing hard for every mutual fund to pay a certain amount on the ground that this is AMC, this is not the recipient of services. I think this issue has been going on, that who's the recipient of service since long. Let me tell you, as I gave the example of deposit insurance service, the services rendered by a subsidiary of Reserve Bank of India. In service tax, DICGC has charged service tax to the various banks, and banks have taken credit of such services. The department sought to deny that credit on the ground that banks are not the recipient of service. Ultimate beneficiary of the service is the depositor, because insurance means whatever if the bank fails. Recently, Sunil Bank has failed. All DIGC is ensuring that the payment of the depositor is made to them directly. So ultimate beneficiary is the account holder and not the bank. Therefore, bank is not the recipient of service, and hence the tax, the credit should be denied. They've gone. The initially tribunal held the view that credit is to be denied. Then the larger bench was constituted. Larger bench upheld the availability of credit, and even now Kerala High Court has approved the larger bench judgment. So the point which I'm making is, in financial sector, who's the recipient of service has always been the crux and dispute. What we must see is who's paying the amount is the most relevant. Prior to 2018, every AMC has paid the amount. Our recipient of service definition is given in section 2(93) has said person is liable to pay the amount. All the contract of fund manager agent is with the AMC. AMC has paid the amount to them prior to 18. Therefore, the question of AMC not being recipient is not correct. And assuming for the timing they are not recipient, they avail the credit. When they included the amount, when they charge the agency commission amount to the fund, they have included that cost, and they already paid GST, and therefore the credit is straight away reversed. Hence, no question of reversing the credit. But anyway, department has their own view, and investigation is on. Let us see what finally it results in the amount. Friends, I'll just go to washroom and come. Just Yeah. Sorry. Let us come back. The next one is you have seen the banking and asset management company. Next is insurance services. Bank also has the security lending issues. They, very often the mutual fund goes on lending the securities, because there are various companies who make the short sale, and when they are required to give delivery, they take a security on loan and send it out. From October 19, it is on reverse charge basis, but prior to that, it is payable by the forward charge. Department is investigating that the tax is payable or not. In our opinion, no tax was payable in security lending. However, after 19, everybody who's lending, receiving it, they are required to pay the tax. Prior to 19, many of the banks and mutual funds and all those things, because of the small amount, they may have paid the amount and will contest under protest, and then they will contest when the show cause notice comes. The place of supply in case of mutual fund and AMC, it is of course the recipient of this, so it doesn't have much problem on this. Reversal of credit, because all investment are made by the funds and not by AMC. Generally, AMC, if at all they have their surplus fund which they invest in the other places, locations, they may be required to make reversal under Rule 42. But otherwise, no, all their services are taxable, and therefore no GST, no reversal under 42 is required under that. We come to insurance services, which is the third one. This covers both life and general insurance, and we have a lot of problems with the insurance services. There are n number of issues. I mean, if the gentleman who was being referred by Kabraji is available, he can probably throw more light on the issues which are there. I'll try myself best to do it. Life insurance service definition is there. We all know life insurance is a contract made between the two policy holder and the insurance company, where normally on the happening of any death, or nowadays health insurance you have for any critical illness, you are reimbursed the amount. The insurance service is one of the life insurance service is one service where the face value of the service, face value of the contract is always returned to the policy holder. This factor you must remember. This is where we're causing a lot of problem to explain to department that what is the consideration for the service which I render. The person pays me 100 rupees premium. Is the 100 rupees is the consideration for my services? The answer is no. Out of 100 rupees, I am required to pay back the X amount to the policy holder, either on happening of maturity or on happening of certain incident which is there in the policy. So I keep aside 90 rupees, go on investing, and I see that the maturity, I am able to recover, say 5 lakh is a face value. I have 5 lakh rupees, which I pay back to the policy holder. Therefore, 90 is not my consideration. 90 is amount which is, I am a custodian, and I go on investing for the policy holder to ensure that the tax I am able to return. And therefore, the liability is required to be created. Liability is required to be computed every yearly. Actually computes the liability, that your probable liability is X amount, and he sees whether investment is there or not to that extent. Now, this is a main factor which we must realize. This is not the case in general insurance and health insurance. See, health insurance, if only a person falls sick, that we are liable to pay, the insurance company is liable to pay. Otherwise, the entire amount becomes his income. And general insurance, again, the entire amount becomes income if, unless something happens, accident happens, no amount is required to be paid. Therefore, in order to ensure that the tax is not payable on the entire amount, that rule 32(4) has been created. Now, before we go to the 32(4), general insurance has been defined like this, which is a general insurance is fire, marine, or miscellaneous business. There are so many others are there, and whether carried on singly or in combination, one or more of this thing. That definition is not much relevant, or it doesn't give much thing. Registration, as I explained to you in the initial stages, that the registration is required to be taken at each state for each of the branches separately. Earlier, one single registration was there. There was no ISD registration, but now you have each branch's registration, your ISD registration separately for each of the insurance companies. And that itself is a big issue to be dealt with by the place of provision of service. Again, the same, either 12, 13 or this, the place of insurance supply is to a registered person with the location of such person, wherever is registered, to a person, other registered person, location of the service on the record of the supplier. The first one applies to generally general insurance company, because most of the companies who are general insurance are registered, are providing services to the registered person, like various companies who are engaged in the business. But of course, individuals are there, like car insurance is there, society register the building there, you may not be registered. Therefore, you have both registered and unregistered. But life insurance companies are only providing services to the services to unregistered person, and therefore the service service in the record, address in the record of the supplier is the place of to determine the place of supply. So this is a straight away. It, as I may explain to you, that this determination of place of supply does not cause a big issue, unless of course under the border cities like Delhi, Gurgaon, or you have Vapi and this thing, or you have Kolhapur and Hubli. These are locations which are located near to the state border, and there it is possible there may be overlapping, that the person in Delhi, Gurgaon, may go to the branch in Delhi and obtain insurance, in which case IGST is payable, but then they may not have separate in their system location available, and therefore that is sometimes causing an issue. Otherwise, there's no problem in the IGST. Problems which we face in the input tax credit, unlike, as I explained to you, the bank has 50% reversal, and after 50% reversal, there is no need of any more reversal. But in the insurance services, there is no such formula which has been given. The exemption is provided to various services under serial number 35 and 36 of the notification 12/2017. Like in the life insurance, you have Pradhan Mantri Yojana is there, Varishtha insurance plan is there. There's so many other plan wise it is there. Micro insurance is there. Same way in general insurance, Janta, Sahkari, Janta insurance is there, general insurance is there. Like so many, they're listed out. The problem which is being faced is, you have to look at rule 40, this necessary to understand rule 42, 43 of these. 42 divides various input services into 5 categories. First one is not used for business, and that normally is not there in this company. Second one is 17(5), which credits are not there. You can't avail the credit of these items at all. Third one is which are used exclusively for exempted supply. So therefore I said, if you have an exempted supply in general insurance and you pay any commission to the agent who has procured, help you to procure this, then you are not entitled for the credit at all. So this is third category. Fourth one is the category which is exclusively used for taxable. So one you have exclusive use for exempt, and second one you are exclusive use for taxable. So commission, if you are using for services which are for taxable, then you are entitled for a full credit. After 4, you divide into 4. The fifth one remains as a common. So common service is what? Suppose you are renting premises there. From rented premises, you are doing both the services, exempt supply and taxable supply. At that only you are required to use reverse. Apply the formula for the purpose of reversal under 42 and 40. This is a new formula which has been given after 2016 in service tax also it was there. Friends, practically the life insurance or general insurance are facing big problem because there are lakhs of insurance policies are there. Not 1 or 2, lakhs of insurance policies are. You can understand motor car. How many policies will be there? Companies, each location, there are thousands of lakhs of companies are there. Each one obtain registration. Now, some of the policies are exempt to keep policy level record to substantiate the exemption and taxable and non-taxable is a huge task. Many companies are able to comply. And thereafter to explain this to the department is creating a lot of issues. I mean, whatever, unless you are willing to reverse on the entire credit, which will be very substantial amount, even if you have maintained separate record, to department is hardly able to verify, and they invariably give you notices of huge amount, considering the entire amount as a common credit. And this creates problem in reinsurance also, because reinsurance is generally taken at the policy level and at the broader level. Therefore, first problem which we face in the insurance sector is maintaining record at 42 and 43 and doing this thing. Therefore, some of the insurance company feel better to ask for reversal on ad hoc basis of 10%, 20% and finish off the matter, so that these one doesn't have to go on explaining and go on getting a show cause notice. But this is more based on a fact. When you're advertising, say, X policy, which is taxable, and you also have your logo on that advertisement. Now you say, I have advertised the X policy. The department says logo is also there. It advertises in general. Now you go on fighting this. Because this is what happens normally. And therefore it is causing a problem in the allocation of this thing. But if you are able to maintain the record properly, as I explained, then you have a good chance of success. You should categorize your input services into 5 categories, 1, 2, 3, 4, 5, which I already explained to you, and then reverse proportionate credit only pertaining to input services and not for others. That is first aspect of this. Valuation of life insurance, I explained to you that the life insurance service is one service, unique service, where the face value of the amount is always refunded back to the supplier, to the policy holder. And therefore, what the department has studied and arrive at certain percentage of the premium amount. So therefore, you look at clause A, what it says is gross premium charge from a policy holder reduced by the amount for investment or saving. As I said, I give my example 100 and minus 90. 90 is for investment or saving on behalf of the policy holder. And therefore, this amount I invest, that's not my consideration. The A itself says I am required to pay only on 10 rupees. And that percentage they have computed and they have arrived at this percentage. What the department has been doing is that 100 minus 10, they say it is an exempt supply and you are required to reverse the exempt supply towards the 10% under Rule 42. To explain this by example, if you have 25 rupees, 25% is the taxable value on 100 rupees premium you have collected, 25 you pay the tax. Department says 75 rupees is an exempt supply. And therefore, you pay reverse 75% of the value of the amount, credit which you have taken. Now, this is totally incorrect. As I explained to you in the case of these license policies, the 75 rupees is not your consideration because that amount you are refunding back to the policy. Either today or tomorrow, you always keep it aside, that amount, and for the purpose of building up the face value of the amount. But however, this problem is going on. This problem is the service tax also. This problem is the GST also. Service tax, we had one better thing. That was only at the centralized location, one registration. But now we have 32 locations, 32 registration. Each of office is raising these queries, and insurance companies are left, right, and center replying to these queries on this thing. But anyway, I must tell you that these were resolved in the service tax, and we have been successful in convincing the tribunal that we are not required to reverse the credit as there is no exempt supply. Now let us examine the department. We have been arguing that look, what is acceptable in service tax should also be accepted in GST. But department says no, that was in service tax. Now in GST you pay the amount. We must explain what is there in the why department says so. This is a definition of exempt supply. And if you look at exempt supply, means supply of any goods or services both which attract tax or which may be wholly exempt, which attract tax at nil rate, or which may be wholly exempt from payment of tax under section 11. So it is not attracting tax at nil rate. It is not wholly exempt. There is no notification exempt under section IGST. This is the more crux and includes non-taxable supply. As per department, it's towards the value is to 75 rupees an example, is towards a non-taxable supply. And therefore it is exempt. Kindly see, non-taxable supply means a supply of goods or services or both, which is on which tax is not leviable under this act, which is not leviable tax under this act. So what you need to see is that there should be a supply on which no tax is leviable. As of now, there are only a few items like alcoholic liquor for human consumption on which tax is not leviable. B, there is another item called petrol, diesel, your gasoline, gas, which item which are specified in section 9(2), on which the tax is not leviable. The rest all item tax is leviable. We have been arguing that look, you are insurance companies make the supply of only life insurance services. Please identify which other supply which you are having on which the tax is not leviable. But department is considering the non-taxable value as a non-taxable supply, and huge amount of reversal is being asked for because, as I said, tax is payable on 12% or 25%, whereas 75% is towards investment. And that if you ask for reversal on that, the entire 75% of my credit also goes away. And therefore we are fighting, we are hopeful we'll succeed on this thing. Then the next tax is on GST on RCM. As I mentioned to you that this issue was there in the service tax era also. In just to give you a brief background on service tax, the service tax problem. Initially, in 2004, when the tax was levied, it was only on the risk premium of portion of the total premium. So if you have 100 rupees premium and your risk premium is 9 rupees, 8 rupees, then your risk premium only is chargeable to tax. Then this issue was raised. The department amended in 2011 and said that any service provided in life insurance is exempt, is liable to tax. After 2011, no such issue of reversal was raised. It is only during the period 4 to 11 that the issue was raised on the ground that only tax was levied only on the risk premium and not on other charges. However, in GST, there is no such item. There is nothing called risk premium and other services. All services rendered under the life insurance is liable to tax. And hence, the question of reversal does not arise at all. However, until the tribunal is formed and we have some judgment from the tribunal, we are going to face this problem. Friends, we do not know how long it will continue with this. Life insurance problem, service providers are facing a lot of problem with this. Next is the GST and RCM. As I said, in case of banking company, recovery agents were liable for services rendered by recovery agent. Banks and banking company are liable for payment of service tax, GST, on reverse charge basis. Same way, in case of insurance, whether life or general, the tax on the services provided by the agent, commission payable to the agent for the services, is liable to be paid by the insurance company. It's simple. The reason is very simple. There are crores of agents, private, LIC, and general insurance, and so on and so forth. And if the department were to go after them for registration, there will be crores or more registration will be there, with most of them claiming exemption from payment of GST because their income may not exceed 20 lakhs. And as against department running to 20 crores of people, they have decided that, look, we will collect the tax from only 25-30 companies who are generally in life, and 25-30 companies who are in the general, another 5-10 companies in the health insurance. So around 30, 40, 50, 60 companies, we are able to claim the reverse charge. We made reverse charge, and reverse charge is going on. There's no problem in the reverse charge at all. So this is a reverse charge. It is payable by them on the services supplied by the insurance agent to the insurance companies. Other issues, many life insurance companies are providing loan against their policy, and the interest earned from the loan is exempt from payment of GST, no doubt on that. But that has been considered exempt supply on the ground that the explanation B below 43B does not apply to the insurance companies because they are financial institutions. They have been reading this, that exception is there, and by way of exception, you are not fitting in the financial institution. But this exception doesn't apply to it because, as I explained to you in the earlier part of my lecture, that this 50% was brought in basically because you are accepting deposit and then extending loan. The acceptance of deposit was a precondition because major input and input services are used in the acceptance of deposit by you. And hence, they said, as against asking you to reverse the major amount of credit, we have asked you only to reverse 50%. Insurance companies are not in the business of accepting deposit and extending loans. Therefore, merely extending loan will not qualify you to come in the exception. You should be accepting deposit and then extending loan in order that you are required to pay 50% and get out of this issue. So, but that department has been considering this as an interest on loan as an exempt supply and asking for reversal of credit. The credit itself is a big problem everywhere. Then many companies are recovering the part of the amount of commission tax payable on commission from the insurance companies and from the agent. The department in the earlier service tax regime also has raised the query that you, whatever taxes payable on RCM, you are required to pay the tax from your own pocket. You need not recover from the insurance companies, agents, and therefore you please, if you are recovered, you pay it again on this. From the this query is going on. In the earlier regime, we have already resolved this and we have already issued the got the orders in our favor. But now let us see, some of the companies have issued notices, inquiry notices to pay back the amount again. Let us see what the department finally does. In general insurance, you have lead insurance. Many of the car insurance, terrorism insurance, flood insurance, all these are, most of these general insurance companies come together and then enter into an agreement. For MOU, they make it. And they say, if such eventuality happens, like flood comes, you have a flood in so many parts of the country, there are a lot of damages which takes place. One insurance company will ask to pay the entire amount, entire losses, then they may become bankrupt. Therefore, what they do is they come to pull together the resources, and then they share the losses also and share the premium also. Premium initially is collected by the lead insurance, and person who collects the lead insurance, he pays the GST on the premium which is being collected by him. And then as per the agreement, whatever is sharing is to be done, that is, the premium is shared to the various insurance companies. At that lead insurance, the person who collects the premium called lead insurance, he pays the GST and then he shares the premium with co-insurer. Co-insurer again does not pay GST because he is getting a premium amount after the GST has been paid on that. The department has been demanding GST or have been considering the amount as exempt supply and asking for reversal of credit. This issue is already decided by tribunal in the case of service tax. However, the department is again running into this queries and issuing notices to the lead insurer. Let us see what they do in GST.
Sir, sorry to interrupt you, sir. Really sorry, but we may run short of time. So really sorry, sir.
Just 2 minutes.
Yeah, yes, sir.
We are coming to last. Stockbrokers are engaged in arranging the purchase and sale of securities through stock exchanges. There is no much issue in this. They earn brokerages on various issues and they pay GST also. In the service tax era, there were a lot of issues on the transaction value and all that. And now that after 18 July, because our stock exchange was levied, stock exchange is also levied tax now. SEBI was not levied tax. Now SEBI is also levied tax after 18 July 2022. Therefore, all the amount which is paid by stock exchange or by any companies is now levied tax at all. Therefore, credit mechanism is available, and hence there is no big issues on the stockbrokers. They earn the income and then they do it. The transaction in securities made by them is not made on behalf of their supply on customers. Does not come into play because they do not have the securities in their name. Therefore, there's no exempt supply which they make it. I think that's not a big problem in this. This we come to the end of it, friends. We hope you have enjoyed all those things. Thank you very much for this. Thanks. Now
Sir,
you can take over, Pooja.
No issues, sir. We would, of course, it's always less to hear you.
Pooja, you can take over.
Yeah, sir. Is it audible?
Yeah.
Yeah, sir, it's always pleasure to hear you and get so many insights, because a lot of time since GST, though it's been 5 years, for case laws and all, we always take references to service tax era only, how the matter has evolved and that's how we proceed further to understand the logic behind any levy or disallowance which the department seeks to make. So that's a really amazing session, sir. We would just quickly take up, we have a couple of questions, but one question we can take up is, this is by, sorry, sir, I'll just read it for you. Yeah. This question is raised in case of reversal again, that in case of this banking companies, 50% reversal is required to be done. So that is also required for RCM in case of reverse charge mechanism payment. That will be. Yeah. So Ankur sir, I hope that solves the question. And we have one more question from Hemant sir, which says, okay, whether the claim received from insurance company be treated as taxable supply as supply to insurance company. I guess Hemant sir, or maybe you can reframe the question, or sir, you would like to take a.
No, it can't be. Whatever claim you receive, it's not for a supply.
Yeah.
You have the underlying supply. I mean, you can't say that whatever fire it has taken place, it is destroyed, and I made a supply to insurance company. It can't be like that. It's a destruction which has been made, and therefore
Yeah.
it's like saying that theft has stolen something from my house, and I made a supply to the thief. It can't be like that. It can't be.
Agree the logic behind it, sir. I completely agree to the logic. I would just now quickly ask Surendra Somaya, sir. He has raised hand. Sir, would you like to ask a question or your queries are resolved? If you could just unmute yourself and let us know. Hello.
Yeah.
Surendra, sir. No, I do not see any. I do not. I'm not able to hear him. So maybe, sir, I guess all the questions are covered up well. And honestly, there was a scope of more questions because you covered everything in your slides. The references to all type of notifications, circular, the decisions of the past for the past service tax era. I think everything was well covered. So there was no question left for the for us to ask. But really, sir, amazing session and really, really thankful to you. WRC is very, very thankful to you, sir, for your time. Yeah. Thank you so much, sir. And yeah, hope to meet on the normal sessions. I mean, since now virtual sessions are for only few days, we all will have to be together and have a seminars on regular platforms. So hope to see you there, sir. Thank you. Thank you very much, sir, for giving us your valuable time. Yeah. And thank you, everyone, even all the participants, for giving up your time.
Can you, Pooja?
Sorry, sir.
Can you now?
Yeah, sure, sir. Sure, sir. Thank you so much, sir. Thank you.